Good morning and welcome. I'm David Hirschman, I'm President and CEO of the Chamber Center for Capital Markets Competitiveness, and we're delighted to work today with our Labor and Employment Division with Randy and Aaliyah on a very important release of a roadmap, a legislative roadmap to make it easier for small businesses to help their employees prepare for retirement and to expand retirement options for all Americans. Now, today's a big day on financial regulatory reform in Washington, and we're certainly expecting the President's executive orders at midday, which we welcome. It's highly likely that they will get more attention than our roadmap, might get a little more coverage than the roadmap that has been so thoughtfully prepared today. But I do want to take a moment at the beginning and point out that from the Chamber, and in fact the creation of the Center for Capital Markets Competitiveness, the Chamber, we realized that if we were going to achieve what we need here, which is a financial regulatory system that enables growth, that facilitates economic stability, that helps ensure that entrepreneurs of every size and shape have access to the capital they need, that we needed to not just be there as critics, but we needed to be at the table proposing specific positive recommendations. So the work that's being released today is just the latest example of that. We have not been critics of Dodd-Frank. From the beginning, we have, before Dodd-Frank even existed, we put out very specific recommendations on how to modernize our financial regulatory system. So I think it's very appropriate, actually, today, as the administration takes the very necessary step to delay the unworkable and impractical DOL fiduciary rule, as the administration takes a step to call for a look at the choke points in our economy that have been created by the layer upon layer of financial regulations adopted in the last years, that we also are at the table proposing new ideas and recommending ways to positively move forward. I hope what comes out of when the dust settles from the immediate headlines of today, what will emerge as an environment where we can really roll up our sleeves and work on a bipartisan basis to achieve important improvements to the retirement system. Many of the ideas in here were thoughtfully put together by a group that Randy and Aaliyah developed. You'll hear a lot more about it today, but I think they really do shine a light on some low-hanging fruit. The low-hanging fruit is always a bit of a misnomer, because just because it's low-hanging doesn't mean it's easy to achieve. But it's both ambitious but practical, and more importantly, it would move the needle. So we're very grateful to our partners here. When we look at the issues that have been the most controversial issues on financial regulation over the last 6 or 7 years, they really have one thing in common. They weren't even part of Dodd-Frank as proposed. Fiduciary duty, Congress looked at it, told the SEC to look at it and act, certainly did not tell the DOL to act. Volcker rule was not part of Dodd-Frank. Certainly conflict minerals and resource extraction. Most of the issues that have ended up being truly controversial were those issues that emerged and were added to Dodd-Frank as Dodd-Frank became a hyper-partisan a bill that ended up getting signed. I hope we don't, that as we move forward, we can find the right way to get the balance right. The Chamber certainly understands that the goal here is not to eliminate regulation, it's to get regulation right. Regulation that will make it easier for small businesses to get the credit they need, regulation that will make it easier for mid-sized businesses to issue debt and finance new equipment, regulation that will make it easier for companies that are rapidly growing to go public rather than waiting or choosing not to go public at all. In short, regulation that will help enable growth to accelerate in the United States from the pitiful 1.5% and 2% we've seen to 2.5%, 3%, and 4%. So that is our objective. That is how we will respond to the executive orders today, by promising to roll up our sleeves and work across the aisle to make financial regulation work right, because it is ultimately, without a healthy, vibrant diverse financial services community, we don't have a growing economy. So I think it's entirely appropriate that as we begin today, we begin by putting some new ideas on the table. And I can't tell you how proud I am to get a chance to work with Randy and Aaliyah and to really benefit from their incredible thought and policy leadership on these issues. With that, let me turn it over to Randy Johnson.
Thanks, David. I'm Senior Vice President here for Labor, Immigration, Healthcare, and Pensions, and my benchmark for success is a little lower than David's. If we don't have any demonstrations at the airports or anything going on outside the chamber on our latest position on the silica reg, it's a success. Look, as David touched on, you know, this has been a work in progress a long time, and of course we've been involved in the high-profile issues such as fiduciary, multi-employer legislation on Capitol Hill with Miller Klein, and my hat's off to both George Miller and Mr. Klein for that effort, and our work in that area, and many others, some of you are who in this room, but the employer community, if there's ever a place for bipartisanship among both the people on the Hill and frankly among special interest groups, and I think AARP is in the room here, but other ones I think we will need to work with, it's coming down to, okay, let's have a duh moment here, which is we got to figure out a way to help workers save for their retirement. Social Security is not up for the job. There's not a lot of money floating around on Capitol Hill to plug the gap. So how can we help employers help workers save for more? And that's what this event is all about. And I've said to Aaliyah many times and others in this group, you know, we can't just say no to some of the state efforts that are going on. We have to come up with our own ideas to say, we're not just against mandates, and as David suggested, we have our own ideas in this area to help remove obstacles under current law to facilitate savings for employers. Now, you might leaf through this and say, well, this is pretty thick stuff, and it's certainly not tweetable, and it's even kind of boring. And you're right, it's all those kind of things, but it's damn important. And so I hope as we're sitting here through today, you keep in mind that this is going to take a lot of work, a lot of shoe leather on Capitol Hill to make happen. And I want to tip my hat to Aaliyah here, who we've been working on this for probably close to 2 years. And beyond this rather thin document, but very substantive document, there's hundreds of pages of effort that's gone behind it. I kid Aaliyah, she's been putting in such long hours, I kind of poke her to see if it's a hologram sitting there or it's really her. But in fact, it has been her. And Aaliyah, without your efforts, we never would have gotten this off the ground, and along with, of course, the task force you and I put together. But it's been your efforts, a little bit of money on David's part and mine, that's kind of got it off the ground. And I can testify to that. And we look forward to you laying out the recommendations in the next panel. Aaliyah, come on up.
Executive Director of Retirement Policy at the U.S. Chamber of Commerce, Aaliyah Wong.
So thank you, both David and Randy. I appreciate that. And thank all of you for joining us today. I'm very excited to lay out for you our report, Securing America's Retirement, a Legislative Roadmap. As Randy said, this has been over a year, 2 years in progress. We started last year, we released a white paper, which the Employee Benefits Committee put together and released under the chamber name. It, as with all white papers, was full of ideas and suggestions. And, you know, I'm proud of this work because at that point, the committee could have sat back and said, we're done, we've put our ideas out there, let someone else take it and do something. But the committee really came forward and said, you know, we need to do more. We need to dive a little deeper. We need to make more concrete recommendations. And so we put together the Retirement Security Council, which is the companies and organizations listed here. And since June, we've been having weekly meetings to come together and talk about recommendations and the ideas in the paper, and really work to get something that was a little bit more concrete. So the paper, it lays out, it has 3 sections. The first section deals with previously introduced legislation. These are things that in whole cloth, the legislation the chamber would like to see enacted by Congress. It's things such as removing PBGC premiums from the budget, or from budget considerations, permanent fixes to non-discrimination rules and frozen benefit plans, changing the rules around hardship distributions and loan provisions to preserve retirement assets, and promoting and expanding ESOPs. Our second section is legislative recommendations. So you may have noticed in that first section, I did not mention open multiple employer plans. This is actually in our second section because there's been a number of legislative proposals. The proposals are very different, and we support all of them because they get to the same goal. So we felt it was important to include it in the second section to maintain flexibility so we can support anything that gets us to where we want to go, which for open MAPs is eliminating the one bad apple rule and getting rid of the employer commonality requirement. There's also other proposals that have been issued, such as electronic disclosure, other legislation. And while we support their efforts to expand the options for electronic disclosure, we felt it didn't go far enough, and so it's in our legislative recommendation section, because we would also like to see electronic disclosure as a default option for employers. And then we do have recommendations where we think the regulators didn't get it quite right, and that's where we have our state-based retirement plans recommendation. There, we hope that to see for Congress to look at and to maintain ERISA protections for private employers, even if they are in a state-based plan, and also to make sure that they don't create an uneven playing field between employers and cities or states that want to operate a retirement plan for private employees. And to that point, on your table, we issued last week, the Chamber, a paper, State Auto IRAs, the wrong answer. And to both Randy and David's point, it tells you why the state auto IRAs are not the right answer, but it also gives several recommendations that can be used to expand the employer-provided system instead of going to a mandated system. And in the second section, we also have a number of rules that we feel need to be updated and modernized. For example, the involuntary cash-out limit has not been updated since 1997. And so what we recommend is that you increase that limit to $10,000, which is what the amount it would be if it had been indexed since 1984 when it was originally implemented. The minimum required distribution rules, age 70.5 was put in place in 1962 and has not been updated. The Chamber would like to see those rules eliminated completely, but if that's not politically feasible, we do have alternate suggestions that would modernize that rule and make it more amenable to the current situation and demographic shifts we are seeing. And small businesses. Everybody on the Hill talks about small business. We talk about small business. But one thing we notice when you look at the advisory councils to the different regulatory agencies, there's no dedicated voice for small business. So we recommend that each of the advisory councils have a dedicated voice for small business, a dedicated representative for small business, so that their voices are heard throughout the process and can be a consistent voice as we talk about retirement issues. The third section of the paper focuses on policy ideas for congressional action. So I want to highlight that these are not ideas that are long-term goals. We see these as immediate items, but they need more vetting. Some need vetting due to circumstances. A good example is the fiduciary rule. As David mentioned this morning, we're seeing that the president is working on an executive order to delay the rule. So where we move forward depends on what happens now with excuse me, in the administration, but also there's ongoing litigation and there is movement on Capitol Hill. So as we move forward with that issue, it will depend on kind of other things that happen around, and we will continue to work on that issue. Another example is tax reform. While we have definitive ideas for tax reform, obviously where we end up will depend on other people's ideas on tax reform and how that shakes out. So that will be something, again, not a long-term goal, but as ideas and proposals are put forth, we will immediately work to formulate our ideas and lay those out. And then we have then there's some things that need to be vetted just more generally. A great example of that is multi-employer plan pension reform. It is an issue that is difficult, and there are no easy answers. And so while we have a number of ideas, it is something where we feel we really need to work with other partners and be open to different ideas and compromise and work through that. And then finally, we have ideas where we just feel more education is required. Financial literacy is a big issue, and within that, retirement literacy is a big issue. So that's something we want to work with Congress to really promote and try and get them to create greater incentives. Along the same lines, private disability insurance, trying to educate Congress also on how that can be helpful in some of our, if there's private disability insurance, can impact some of our entitlement programs, and creating incentives for employers to implement those programs. So what we've done with this paper is created a pathway. We hope this is something that Hill staff can look at, take ideas from, put into legislation, pass through. But we realize it doesn't include every stone on the path. There will be other ideas that we are open to, other ideas that we would like to discuss. And there's also room for this path to move and take a different direction. All that to say, we are open to all ideas, and this paper isn't the end-all be-all, but rather the start of what we hope is a conversation with all of you in the room, with Congress, and with the administration, and all other interested parties. Our main goal here is to move forward to expand incentives and opportunities for the employer-provided retirement system, and we look forward to working with all of you to do that. Thank you.
Please welcome to the stage Chief Economist at the Investment Company Institute, Brian Reed.
Good morning. I want to thank the U.S. Chamber of Commerce for inviting me to participate in today's conference. As Randy and Aaliyah have noted, today's conference is focused on improving retirement security for all American workers. And this is one of the most widely discussed public policy issues in our time. And there are many proposals and ideas in play and in the public space as we discuss this public policy concern. What I'm going to do today is talk about one of those programs, state-mandated IRAs. These programs would mandate that employers either offer a retirement plan to their workers or automatically enroll their employees in a state-run plan. It's a concept that has been gaining traction in many states, and several, including Oregon and California, are close to rolling out their programs. These plans have been touted as being able to significantly enhance retirement security for millions of American workers. But what I'm going to talk about today is that there are a number of overlooked challenges that these plans will face that raise questions about their viability and how effective they will be in improving Americans' retirement security. And if you'd like to look at my slides, they are in your folder that are there. So if we look at the main concerns that I'm going to highlight today, there really are five. The first of all is that the coverage gap that people talk about is often overstated. And the problem with that means then that the market for potentially bringing in uncovered workers is much smaller. Secondly, workers without plans often lack income for retirement savings. That is, many of them are very low income, are struggling to meet their basic needs such as paying for rent and food, transportation. Finding an extra 5 or 10%, as many of these plans are trying to achieve, is probably unachievable. Third, recovering the fixed costs for these plans will be difficult, particularly if many of these plans have a lot of small accounts. And recapturing these startup costs will take a long time. Even studies coming out from Boston College, which assume, and at least as their baseline, look at the most optimistic scenarios, even have very long pay down periods for the costs that are built up at the front of the plans. And finally, these plans have many untested features. So I'm going to walk through each one of these. First of all, it's the potential size of the population that could potentially participate in such plans. Now, some of the most widely quoted data on coverage and looking at the coverage gap come from the Current Population Survey. These data are shown on the left-hand side here. The Current Population Survey is done annually. It's a household survey done by the Census Bureau. The question, this response is based on a single question in the CPS. And the problem is that the question has notoriously undercounted the number of people who actually have coverage in their current employers. In fact, about 10% of federal workers say they're not covered by a pension plan. If you look at, so the coverage gap would suggest from the Current Population Survey that it's close to 60%. Another survey that's done, which is an employer-based survey that the Department of Labor uses, is the National Compensation Survey. This survey would indicate that about a third of all U.S. workers are not currently offered a plan at their current employer. For full-time workers, that's about 24%. Now you say, well, still, that's 24% or a third of American workers who are not covered. And so, therefore, something is needed. And we would agree that we need to find ways to continue to enhance and improve retirement security for American workers. The challenge is that if you have a much smaller pool of potential workers that could participate in these plans, the economics begins to change, particularly if you look at the income levels of many of the workers who indicate that they're not covered on the current population survey. So what these data do are using the current population survey data on individual worker income. And the data on the left is a distribution of incomes, salary and wage income for all private sector workers. You can see that the median is about $31,000 a year. At the 80th percentile at $64,000, and and for the average for all private sector workers is $45,000. Right? So there's some skew in there that causes the average to be a little bit higher than the median. If you look at covered workers, those numbers are higher, obviously. They tend to be more likely to be higher income workers, and so the average income is about $57,000 with a median of $42,000. If you look at uncovered workers, though, those numbers are considerably smaller. So the median income is $23,000. Many of these workers are part-time employees. The average income is $33,000. Finding an extra 5 or 10% of your income to set aside for retirement security when you and your employer are paying about 12.5% of your income into a retirement security plan is going to be a real challenge, and I think it's going to be a significant limitation on what these plans could reasonably achieve. If these plans do struggle to begin to build balances, and to begin to build balances in a significant way because of a smaller population that could potentially participate in them, because of the low incomes and maybe potentially higher opt-out rates, low contribution rates, what we'd likely see then is that the cost of the plans would begin to overrun the economics of them. What do I mean by that? Well, the Oregon plan, for instance, is planning on charging participants 1% a year and charge them that until they can recover all of the startup costs. Now, if you look but part of the feature of the Oregon plan is they will have a private sector provider providing the services for about $35 per account per year. Now, $35 per account per year sounds pretty inexpensive. And for a $10,000 or $100,000 account, $35 is inexpensive. For a $1,000 account, that's 3.5% of your income every year, 3.5% of your assets every single year, right? 3.5%. Depending upon the return environment, what these plans are invested in, the expenses alone could be enough to actually swallow up. And if they're charging 1% a year for plans for participant accounts up to about $4,000, they will not generate enough income to actually pay for that $35 per account fee every year. And as those fees begin to not be able to be paid, the balances begin to, and the unpaid component of this begins to mount and begins to make the plans more and more economically unviable. So Boston College has put out some of their analysis on how long they think the payback period will be for the Oregon program. And what's valuable about the Oregon program is they actually have some very concrete numbers. They've done a lot of work to look into how you provide this generally overall auto-mandated IRA to the private sector. Under what I would say is a very optimistic but baseline scenario where they start out at a 5% contribution rate at auto enrollment. They have very high participation rates, so very low opt-out rates. And eventually that these contribution rates rise from 5% to 10%. It takes 9 years to fully recover the costs. That is, you have 6 years just to break even and then 3 additional years to recover the costs that hadn't been paid initially. If, on the other hand, they bring the cost to the participants down to 75 basis points a year from 1%, it'll take 12 years. If the contribution rates are only 3% and people don't participate in auto escalation, then the payback period is 17 years. And if the private sector provider begins to believe that they can't cover their costs and have to increase their costs from $35 per account to $45, the cost of payback is 11 years. Now, this assumes ongoing participation, continual participation by workers, so once they're in, they continue to participate. It doesn't account for possible many small accounts that just languish because they've moved to an employer that's offering a plan, and so they sit there, and that the Oregon plan would then have to continue to bear the cost of maintaining these small accounts. There are several other untested features of these plans that I think increase, again, the probability that these plans will not work as intended. First of all, state and local governments in the United States have no experience with auto-enrolling private sector workers across an entire state. They may auto-enroll their government workers in plans. Private employers may auto-enroll their workers, but these are microcosms of trying to auto-enroll uncovered workers in an entire state. And if you magnify this to even larger states for California, where you have many part-time workers, people are moving from one job to another, it becomes even more challenging. So one of the programs globally that's been touted that has a lot of similar features is the UK's NEST program. It's an overlay on top of an existing pension system in the UK, so it's not starting from a situation where no one was covered by a pension plan. They were targeting largely the uncovered workers, which were lower income on average, and this program's been around since 2010. Now, a lot of people have touted the number of participants in this plan, which is approaching 2.5 to 3 million participants, and they've touted the amount of assets in the UK pension plan, NEST plan, which is approaching about £1 trillion. The problem is, if you take those two numbers and divide the assets by the number of participants, you get an average account size of £275 after 10 years. Right. Now, if you go back to the two charts ago, when I showed you that an account under 1,000 is going to be generating costs well in excess of what they are charging, this will make this program completely unviable. I should also note that the UK NEST program, as much as it's touted as a success, if you take the costs of running the program and divide it by its assets, the costs every year total about 12.5% of the program assets. 12.5%. There is no way that that could operate. It receives significant funding from the UK government, which eventually the program is supposed to pay back. But after 6-7 years, this program is completely economically unviable. 529 plans, which have been a success in the United States, are often made as a comparison about how these auto-enrollment plans will work. The problem is 529 plans are not the same as an auto-enrollment plan in a state. People are choosing to participate in a 529 plan. They tend to have much higher incomes. So if you look at the population of U.S. Americans, households who are participating in a 529 plan, over half of them are making more than $100,000 a year. Right? That compares to auto-enrolling people who are making, on average, $25,000, $30,000 a year. This is a very different type of program, and the viability of this is, I think, in question because of this. And finally, and I think this is a concern should be for everyone, that these plans, if they follow, get the safe harbor, if they're constructed to get the safe harbor provisions that the DOL has laid out, will lack the ERISA protections that other private sector employer plans will have. So in summary then, I think the challenges are quite formidable for these plans, and there's a very high probability that these plans will not succeed. If that happens, the workers in these plans will be no further along in building a secure retirement and ultimately be years farther behind in achieving their retirement security. That concludes my prepared remarks. I'm happy to answer a few questions, if you have any. Yes?
Every month in a bank account. Right? I mean, we all want savings, right? I mean, I was brought up, always save. And what we're trying to do here is encourage people to save. If I were just to put my money in a bank account, every month, if I set up an auto pay, would the cost be more? Am I losing money that way too? Are the administrative costs more just to every month put my money in a bank account?
So I think one alternative, to say other than a bank account, which would be a possibility, is there are many discount brokerage firms in the United States that offer an auto contribution IRA, where I can go in and they don't require any base amount. You don't have to bring in $1,000 or something. You can just say, I want to have this automatically deducted from my bank account or have my employer pay that. You pay the fees that are part of that mutual fund, but the ones that we have looked at typically do not have any additional account fees. And so this is a means of accumulating savings in the private sector that already exist. Now, you're not auto-enrolled, and one of the pushbacks that we have on this is that, yes, but these plans where you can get very low-cost investing, you're benefiting from an already very large pool of assets and the scale economies that are available, which the Oregon plan does not have, is that those plans you have to make a concerted effort to go in and to enroll. And we are, I think the point here is that is by auto-enrolling a large number of employees with very modest means makes this a much more challenging proposition. And much more expensive than if you would go and do it on your own in the private sector. I think that's one of the points that we have made, is that as workers begin to find this out, they may choose themselves then to simply auto-enroll in a private sector program, an auto IRA, or an IRA program, as opposed to participate in a state plan. All right, thank you very much.
Joining us on stage for the Innovation in Retirement Planning and Design panel are Janet Boyd, the Dow Chemical Company, Rick Jones, Aon Hewitt, and Lynn Franzoy, LLF Consulting.
Those lights are bright. Okay, good morning. And I think this panel, Innovation in Retirement Planning and Design, really fits into this ongoing discussion on the shifting paradigm of retirement. We're fortunate to have with us two great speakers today. Janet Boyd, who is the Director of Government Relations and Legislative Counsel for the Dow Chemical Company's Federal Affairs Office. She currently manages the company's federal policy positions and advocacy on pension and health benefits, as well as tax policy. Janet serves on the boards of the ERISA Industry Council, American Benefits Council, and Corporate Healthcare Coalition. And she is currently Dow Chemical's lead for the National Coalition on Benefits. Our second speaker today, Rick Jones, is a senior partner and leader of the National Practices Group for Aon Hewitt's Core Retirement and Investment Practice. He's a fellow of the Society of Actuaries, an enrolled actuary, and a member of the American Academy of Actuaries. Rick has 30 years of experience with the firm, and he's consulted on a broad range of retirement plan, financial strategy, and design issues, including benefit design and competitiveness, financial strategy, and different approaches in mergers and acquisitions. So with this, I'm going to turn to Janet and Rick to tell us a little bit about what their organizations are doing in this new innovative ways to approach retirement planning. Janet?
Thank you, Lynn, and thank you to the Chamber for giving me this opportunity. So one might wonder why an old Midwestern company with a DB plan would be on an innovation panel. And there's something to say for that. And I know many of you are quite familiar with DB plans on some of the advantages of having DB plans. In many cases, it's easier to fund if you have, irregular cash flows in your company. You can or at least accelerate funding in order to accommodate those kind of fluctuations. So that's kind of the underlying rationale for us to stay in the DB plan. So we have employees and management that have over the years wanted to keep Dow in the DB system. We started out, as many companies did, many years ago with a very classic final average pay plan. And as we were getting into the 90s and after passage of ERISA, it became quite clear that the traditional final average pay plan design was too risky. And so we started working with our consultants to try to determine if there was some other way we could stay in the system and alleviate some of the risks, particularly the risks of trying to anticipate funding needs. And so what we did is we, working with our consultants, devised what was eventually called a pension equity plan design, or PEP design. The PEP design, I think probably many of you are familiar with. It basically, what you do is again, it's got some of the same features as a final average pay plan in that you use that as your basis for developing a notional account, much like you do in a cash balance plan. But the difference is that instead of just using interest credits against that amount, you actually create these credits that that actually can increase or be revised and made flexible depending on the needs of your population. And so our credits that we use against the final average pay amount is actually accelerated as you get older. And so you actually accelerate the value of your plan quicker. And then at the time when you leave service with Dow, and this is very typical for a pension equity plan, you actually switch the type of accruals. The accruals no longer are based on final average pay. You switched into a more traditional cash balance feature where the accruals increase against an interest rate. And in our case, the interest rate was set in the plan and actually didn't vary year over year. So it was very easy for us to work with that kind of design. It was much easier for us to predict what kind of funding we needed. The employees liked this design because it matched a little bit more of what they were used to. They knew that if they were making a lot of money at the end of their careers, that would be reflected in the amount that they received. And so this design worked well from an employee perspective and quite frankly even from an employer perspective. But it didn't really meet the needs of Treasury and the IRS. Shortly after we developed that plan, the cash balance controversy became quite troublesome. And a lot of the controversy in the case on public policy was more focused on the fact of the way some of the companies were actually transitioning their existing employees into these new plan designs. In the case of Dow, we decided to do a greater of conversion, and that prevented any of the problems that you might have with employees being concerned about the new system. But that being said, the Treasury and the IRS remain, and even Congress remained very concerned about it. And as the cash balance issue and a lot of DB plan concerns were coming to fore, that's what led to the passage of the Pension Protection Act. And with the Pension Protection Act, we got not only some clarity with regard to how cash balance plans should be devised, we also got some clarity with regard to the PEP design. But unfortunately, Treasury and IRS remained very concerned about the PEP design, even beyond what was clarified in the Pension Protection Act. So we were continuing to accrue some risks that eventually that the Treasury would say, no, this isn't an appropriate design, and therefore there would have to be a lot more accruals than we were expecting to be able to have. And again, this with DB plan, you have to be innovative in order to make sure that the risks are balanced. And so what we decided to do after passage of PPA is, and it became clear what the guidance was going to be, we again innovated and switched to maybe not as innovative, a more traditional cash balance design. So we are still in the DB system. Our new employees are under this new design, new cash balance design, which is a simple 5% of income every year with a interest rate that's adjusted according to government provided rules that are in the guidance for a cash balance plan. So we pretty much hold the line on exactly what was permitted. So but Treasury, by giving us guidance, and Congress, by giving us some assurance, we were able to innovate in this space. Now, one other thing I wanted to mention that I meant to discuss when we were talking about the existing PEP design, which, by the way, still continues for our existing employees. They have also another innovative option, and that is if they so desire at the time that they retire from Dow, they can actually move their 401k plan fund into our pension plan fund. Again, when you have a PEP design, you have an account, and through this account, you can actually move the 401k funds into that account, and then it accumulates, and then those individuals have the advantage of the annuitizing formulas that we use in our PEP design. They get to use that for their 401k plans. So in short, this is, you can be innovative in this space. It's tricky, but companies like Dow, and I'm sure a lot of other companies that are in this room, it can be worth the effort to try to make it work within the existing system. So thank you again very much.
Okay, Rick?
Great. Thank you, and good morning, everybody. It's been a pleasure to partner with the Chamber on the Retirement Security Council, and certainly Lynn and Janet on this panel, so thanks for the opportunity. Recently, I read an interesting definition of innovation. So I was reflecting on the topic today of innovation in retirement planning and design. So what is innovation? What is innovative? And I read an interesting definition that helped me think about it a little bit more. And it's a pretty simple definition. It was changing what you do before you need to. Before you're forced to, you're changing and adapting, again, before market forces take you there because you come along kicking and screaming. So with that as a backdrop, I thought about 3 expectations that we, Aon Hewitt, have for corporate retirement planning in the coming years, and I'll spend a little bit of time talking about each of them. The first expectation that we have is that defined contribution benefits will continue to be the norm for most industries. There will certainly continue to be the Dow Chemicals of the world that will want to do what they need to do, and that's valuable that they be able to do that because it meets the needs of their workforces. But defined contributions will continue to be the norm, but new solutions will emerge, new innovations will emerge that will make them more attractive, more powerful, provide greater retirement security. So that's expectation number 1. Expectation number 2 is that the current pension financing environment under U.S. tax code and otherwise will, over the coming years, produce better funded pensions. So I'll talk a little bit about that. And number 3, pension settlements, the notion of issuing lump sum distributions or offering lump sum distributions or offloading benefit coverage through insurance transfers, that will continue and pick up steam. So those are the 3 expectations. So expectation number 1, DC plans are here to stay, but we'll see innovations. Why will we see innovations and new solutions emerge? Number 1, the well-documented coverage gap. There will be continued efforts to make sure that more Americans are covered by tax-qualified retirement plans. Innovations are necessary to do that. Reason number 2, there are significant risks and compliance requirements for employers today in sponsoring a tax-qualified retirement plan. Employers will be at the table and are at the table to make sure that there are new designs, new offerings in the future which appropriately balance risk and reward and compliance for them as entities and plan sponsors. Number 3, we are in need of secure forms of lifetime income as the world is shifting away from defined benefit pension plan coverage, including the Dow Chemical situation of moving away from a traditional annuity-based benefit. There will be greater need for secure forms of lifetime income. So innovations will be produced in the marketplace to support that. And number 4, we just think that better outcomes can be produced by some innovative designs. We, Aon Hewitt, have a concept which is a version of the pooled employer plans included in the Retirement Enhancement and Savings Act.
last year, but we call it the registered retirement plan concept. We've done some modeling which suggests that participants could see a 15 to 75% or more improvement in retirement income if they follow through and participate in the default activities inherent in that design. So a significant upside if we can shepherd participants into appropriate and healthy behaviors, if you will, from a financial and retirement planning standpoint. I mentioned earlier the Retirement Enhancement and Savings Act from last year. We think that that was a great step in the right direction of enabling these types of pooled employer plans, multiple employer plans that we think that can really address some of the coverage gaps and concerns, as well as provide for better outcomes. I was particularly struck by some of Brian's comments in terms of the ability or inability, as the case might be, to start those plans from scratch. And one thing that we believe is critically important in that transition from a single employer plan sponsor world to a multiple employer plan sponsor world is the ability for existing plans to gracefully port their people and their assets into the pooled plans, to create that base, to create that level of infrastructure investment opportunity that again, Brian suggested wouldn't be there if we, in effect, started from scratch. So we think that's a critical component of that equation that we need to address. So we can talk more during the Q&A or offline, as the case might be, but expect innovations in the DC space, but expect that to continue to be the norm for delivering retirement income. Second expectation, the pension financing environment and the regulatory environment will produce better funded pensions in coming years. So you might say, okay, where's the innovation in that? I guess back to my definition, we believe that employers and plan sponsors will take actions before they need to. That is because, number one, PBGC premiums are increasing significantly. They will voluntarily contribute ahead of those PBGC premium increases. There's the potential for corporate tax code changes. If corporate tax rates go down significantly, there will be a acceleration of cash contributions into corporate DB plans to accelerate the value of those corporate deductions into plans. If there's a repatriation holiday for overseas earnings being brought on shore, that'll produce funds that, again, for the similar reasons, can be used to and invested, if you will, in reducing pension funding or pension debt. The other reason that we'll see better funded pensions is well, two reasons. Number one, the plan sponsors will contribute generously to effectuate plan settlements. You'll need cash to settle, so the cash will in effect accomplish that. In the pension settlement space, again, this is the notion of using a lump sum offering or an annuity purchase from a corporate retirement plan to offload liabilities from the plan sponsor's balance sheet and their retirement plan. That will continue and pick up steam. Our estimates suggest that if you look at corporate DB plan liabilities, approximately 6% of those have been settled since 2012. It's a pretty material number, 6%, but it obviously leaves quite a bit left to go, and we expect that there'll be continued activity in that space. There will be innovations in that space, which will further enable that, and we've got a few thoughts on what those innovations could be. Technology will enable better transmission of data between plan sponsors and insurers, so the insured markets will execute more quickly, be able to price more quickly and transact more quickly based on involvement in technology and better data and data flow. There'll be better transparency in pricing for insurance buyouts within the corporate DB space. Better data will enable that. More sophisticated mortality analysis will enable that. Better use of zip and geocodes, as well as a slicing and dicing of populations to match the cohorts and the demographic characteristics of what an insurer would find attractive based on what they need to fill out their portfolio from a risk perspective. So we'll see greater differentiation in the marketplace to better match risk with overall balance sheet characteristics, and that'll ultimately serve everybody better. It'll be a better risk hedge for the insurance industry, and it'll produce better pricing and better opportunities for pension plan sponsors. We also expect that there'll be some globalization of the pension settlement risk space, with the notion of settling liabilities concurrently on a global basis, looking at uncorrelated risks around the globe, and that being a better risk profile for the insurers. Better underwriting, all of this will take more sophisticated capacity, but we think that'll emerge as that 94% is tackled, if you will, in the coming years. So again, we expect to be continued innovation in the space, and we look forward to actively participating in that.
Thank you, Janet. Thank you, Rick. And, I think it's really quite unusual to hear the terms defined benefit plan and innovation in the same sentence, because it's not what we typically think of. But Janet, it seems like you've done a great job of explaining how you managed to do this at Dow. So could you tell us a little bit about how you explained these changes to your workforce and what the reaction was?
Good questions. I wasn't around, to be honest, during the time when we made the first change, which was from the final average paid traditional design to the PEP design. But again, I think from what I understand from my colleagues, that went smoothly. And a lot of the reason why that went smoothly was at that time, there was a lot of excitement about 401k plan design and the fact that you would be able to actually see your amounts grow, and you had a better feel for what it was. And there was just more excitement about that sort of design. So the PEP design sort of leveraged on that. When we switched from the PEP design to the cash balance design, it probably wasn't as easy, just to be frank. I mean, it came across to many employees, and these were, again, we didn't switch the existing employees to the new cash balance design. We kept them on the PEP design. For a good reason, because there really are differences between the plan, and it would have been very difficult to move employees over to the cash balance design. The cash balance design was perceived by a lot of our employees as more like kind of a supercharged 401k instead of a true DB plan. So I do spend even personally times at, trying to draw the distinction that there really is a DB feature in a cash balance design, that there is a guarantee aspect to it. But I would say that it was a little bit more difficult. But you're in an environment when most of these employees friends have no access to any kind of DB plan at all. And so even though the transition was perhaps not as good as it was the first time, it was acceptable because of the 401k sort of knowledge that most companies are moving in that direction, and we retained our 401k design as well.
Thank you, Janet. We heard a lot this morning about state-mandated plans, including we've been hearing a lot about it during this time, and we heard a really good presentation this morning from Brian. But there's a lot of controversy over state involvement, and there's a consensus, even though there's a consensus that more people should have access to retirement plans and retirement savings. So, Rick, could you tell us a little bit about how the registered retirement plan addresses this issue and why it might be a better option than a state-sponsored IRA program?
Sure, thank you. Again, coverage is a very important issue, and we need to collectively figure out how to tackle that. We believe that employers of all sizes should be able to and can participate in a similar and the same retirement income system. And really the multiple employer plan world, or the pooled retirement plan world, or the registered retirement plan concept as we've envisioned it is really enabling that, where big pools of assets and infrastructure can be used to add value to employers of any size. So we can't have just small employer solutions, and we can't just have large employer solutions. We've got to have solutions that span that, where, again, the small employer community in particular can benefit from the investments available and inherent in having large employers and large pools of people along for the ride. So if you think about that in the context of a state retirement plan, as Brian pointed out so well, I mean, they're going to start climbing the mountain from base camp, and that's going to be very difficult without the infrastructure and the resources to do that. If you envision any kind of a regional or national employer, it'll just produce a patchwork quilt of requirements and issues they'll need to deal with. Obviously, the financial issues as well. You know, I guess the other thing that I'd say is, I would like for all Americans to have access to the same tax treatment, if you will. And IRAs don't provide the same tax limits as employer-sponsored plans. I would like for all Americans to have those opportunities and to be able to participate in plans where they can come along for the ride, so to speak. You know, the example I keep thinking of is my iPhone. You know, we don't have solutions for the technology we have in the palms of our hands or our pockets all day that are only for the large employer set or only for the small employer set. They're really the investments that are made in these tools are there because we, the collective masses, are investing in it rather than just one segment. So that's the example, and I think we have to think about retirement plans in a similar way, that we need to really have a national system fuel it for everybody.
Rick, when you talk about this registered retirement plan, are there any mandates on either the employer and the employee in this program?
No. Short answer.
Sure. Easy one.
We believe in the voluntary retirement system. And as Brian pointed out again, there might be employers for which the economics just don't work. And it's not prudent, and it wouldn't be a good fiduciary act on the part of an employer to put employees in a particular program that if you put $1 in the plan, you might have 87.5 cents in it a year later, ignoring any investment return you might get. So we think that programs should survive on their own merits, and that should be at both an employer level and an employee level. And we think mandates tend to fly in the face of that.
You know, when you were talking about this program, I think you mentioned that there could be a 15 to 75% improvement in retirement outcomes. How does this program produce that type of an outcome?
Sure. Really, three components are included in our modeling that produce that, and I've got all kinds of detail on that. As an actuary, I can bore you with all kinds of details and give you handouts with some information on the assumptions that we use to produce that. But the three components are, number one, professional investment management. We, in our concept design, we've got half of the money going into what we call a lifetime income account, which is invested and managed with the intent that that'll ultimately produce a secure form of lifetime income. Again, that's a default. There's not a mandate there, but that's a default. Inherent in that would be professional investment management, of that 50% managing toward a secure payout during retirement years. The other 50% would be invested in what we're calling a participant-directed account, to give participants more flexibility should they want to exercise that flexibility and how they manage that. Again, in our no mandates world, participants could transfer back and forth between those two different types of accounts. But inherent in that 50% going into the lifetime income account would be professional investment management. And study after study shows that professional asset managers and institutions outperform individuals making their own investment decisions. We took what we think is a very conservative posture and estimate on that. So about 10% of the improvement that we saw was due to the professional investment management, again, during accumulating over the course of a career. So that was factor number one. Factor number two was decreased costs. If you compare a plan with 200 people and 10 million in assets, and the operational costs of that compared to a plan with you know, 1 million people and billions of assets, the costs will go down. Fixed costs will go down and variable costs will go down. Based on some modeling that Deloitte had done, we estimated an additional up to 5% improvement in retirement outcomes by simply decreasing costs and having that flow through to participants' accounts. And then the third is the provision of lifetime income, particularly if people outlive their life expectancy and outlive their savings. And as you can imagine, that can produce a huge improvement in retirement income, particularly in later years if you're fortunate enough to live long and have planned well for that and have somebody backing you up on that promise. So better returns, lesser costs, and lifetime income guarantees.
Thank you, Rick. You know, I'd like to get from each of you your perspective on how you continue to make sure that retirement plans and designs continue to meet the needs of the workers of today and the workers of tomorrow.
Well, I find what Rick talks about is very interesting, and I think companies, even large companies that currently already have the infrastructure in place to be able to do what Rick talks about, we do continue to test and whether or not it makes sense to get out of doing it ourselves and maybe think about having others actually manage it. So far, our company is comfortable, and we continue to believe that we have a big enough population and a big enough fund that it's worth our effort, and it actually helps save costs for us to be able to do it on our own. But I think in the end, and this was what I found very interesting yesterday when we had our benefits meeting here, that there was a lot of discussion about risk and how you assess that risk. And that is how you make sure that you're in the system correctly. And companies like Rick's can help manage that, particularly for smaller companies or for individuals themselves. Large companies are constantly trying to test how best we can do that. And in many cases, we do de-risking. My company has not at all been interested in doing de-risking by shifting it totally to an insurance company. That was very interesting, the assessment on that. But that being said, in order to keep in any retirement system, whether you're talking about a DB system or a DC system, the companies have to be able to assess appropriately the risk and determine if that risk is appropriate, or do they have to make some changes in order to assess that. Rick?
Great. I'm going to echo a lot of what Janet just said. You know, we at Aon like to say we're in the risk and people business, and I think if that gets out of balance in when we're working with our clients and trying to innovate with them, we're going to have problems. You know, from a people perspective, we've got to help produce good outcomes. We're here to talk about improving retirement outcomes. That only works if it's also workable for their employers that are participating in this equation, or the states, or the federal government, or whatever it is. And we think that there's a lot of value in the employer-based system, but it's got to work for them, and it's got to manage their risks appropriately, whether they're financial risks or compliance risks or demographic risks. So it's really that balance, I think, between great outcomes for people and good outcomes for a corporate sponsor that, you know, it needs to be workable on all sides of the equation, and it needs to be workable for taxpayers too. So it's that balance.
Thank you. You know, it's often said that Congress is like 5 to 10 years behind business. So if each of you could just sort of wave that magic wand and have Congress make changes today that would help spur further innovation in retirement plans, what would those changes be?
From a large employer perspective, I think, you know, our biggest concerns remain a lot on public policy, and a lot of retirement is intertwined in the tax code as well as in the ERISA statute. In both cases, a lot of the things that make it difficult for us to innovate is the uncertainty on how public policy is going to be managed in the future. So if we were to wave a magic wand, we'd want some stability on that side. In some cases, we might even ask for improvements. PBGC and the premium structure is, from a DB plan perspective, it can be difficult. I know there's a tension between trying to make sure that the government is protected, but on the other hand, if there's a lot of uncertainty in exactly what those risks are for us working with that system, that is a problem as well. So what we would like to see again is a great deal more certainty from the public policy perspective and perhaps some improvements in how the insurance system works.
Thank you, Janet. Rick?
Come back to the remarks earlier. I think that the multiple employer plans, this RISA legislation passed the Senate Finance Committee 26-0 last fall. Broad bipartisan support. I would encourage Congress to kind of get the other stuff out of the way. I understand there's there's issues and there's competing objectives and there's coal miners and there's all kinds of things. But it's so compelling and it can be so helpful for so many people. I think that's a very important thing to move forward with. But again, I think it's got to work for everybody. It can't be just a small employer solution. It's got to be for the cross-section of employers that want to pursue it. And it's got to work for everybody because we need that infusion of dollars and capital to produce the innovation.
Thank you, Rick. I'd really like to open this up. I'm sure a lot of you have some questions out there, so I'd like to open this up to you. Anybody with questions? And I can't really see that light. Are there any questions out there from anyone? I see one back there.
Hi, this is Judy Carsrud from NAPA. Rick, on your plan that sounds like a map, is the 50% that first default for the lifetime, the guaranteed lifetime income, is that in the form of a group annuity or something similar?
We were anticipating that during the accumulation years, the dollars would be invested with the intent of ultimately purchasing an annuity at the right time for that individual.
Ethan Lipzig, Paul Hastings. I was intrigued by your willingness to accept rollovers from your defined contribution plan to buy annuities under your pension plan. Of course, in an era when many large employers are de-risking, to the extent that option is used, you're kind of risking up. That's assuming, of course, that you're selling these annuities at attractive prices. So how attractive is your pricing, and how many people are taking you up on your offer?
We don't have, to be honest, we probably don't publicize it as much as we should. And so we don't get much of a take-up year to year. We sort of offer it as something kind of attractive as a kind of add-on feature to our 401k / PEP plan, joint design. But that being said, it isn't a core idea. So as far as how it is being perceived as maybe going against de-risking, you're right. And we have engaged in some de-risking activities, but most of our de-risking activities is really designed, quite frankly, to deal with a PBGC premium problem, because we had a lot of very low account balanced beneficiaries, and it made very little sense for those accounts to be retained when we were having to pay particularly the per capita fee. So we were able to and encourage some offloading or de-risking in those cases, but we don't find that this feature of the rollover of the 401k amounts to the pension is having much impact on that at all.
Any other questions? I can't see.
Good morning. My name is Sam Gilbert, and I do work in the small business area and have for all my career. And I must tell you, Rick, I do see reasons that small businesses need a different kind of plan, because some of the rules that have come out have not been small business friendly in the retirement system, and then we've had to go back and change them so they could become workable for small business. So I've encountered many times the rules just don't fit what small business owners want. So I see a reason for different rules and different roadmaps. Just wanted to let you know.
Randy?
So, Jen, this is a general question. I'm curious, people say people spend more time pricing out a car they're going to buy than planning for retirement or picking out their doctor. And people say, oh, people ought to shop around for better health care plans, and they don't. As your company's made changes in health care plan benefits, and the Chamber's gone through changes too, do employees, is there much angst among employees? Do they even ask, or is it sort of like, I got some notice from HR here, I can't understand it, and I'll take care of it later when I retire? It just seems that, we're always concerned about these as recruitment tools, of course, but also how it affects your immediate workforce and presumably morale. But I'm really curious in terms of how much employees, in your experience, pay attention to these kinds of changes, and there's pushback or not, or is it, it's too complicated and I'll worry about it later?
Well, companies like mine spend a great deal of resources every year trying to explain any changes that we might make to our pension system. But to be honest, I think the reason why we stay in the DB system is we're not anxious to upset the apple cart. It is, when you're talking about things like retirement, that's a long-term focus. So year to year, you don't really want to be making a lot of changes. And quite frankly, we haven't. Those two big changes that I described in my opening remarks are really all we have done. The other thing we sort of added to it, as I mentioned, is we did an automatic enrollment with our 401k, and that has actually been well received. We have very few people during the 60-day period that you can back out. We have very few people that will back out. So I might be sanguine or something, but I feel like we don't find there's a great deal of problem, but that is probably because we purposefully try to keep it very steady.
In addition to an add-on to Randy's question, when you look at Dow Chemical, you're such a long time established company. What does your average workforce look like in terms of average age, length of service? Because I think that could really differ in how people would perceive this. If you have an older workforce or a workforce with a longer tenure, they might have a different feeling towards the company and what your goals are.
Yeah, and I do think it's switching a little bit, but for the most part, our average age is still in the upper 40s. So we have an older workforce, and a lot of that is because you hire people in mid-career too. That's not unusual for us to do that. That being said, we also do have people that stay a long time. I don't remember off the top of my head what our average tenure is, but it is long. It's typical old-time manufacturing company.
It's a question.
Yeah, hi. My name's Bruce Wolf. I work at BlackRock. Rick, I was wondering, in a non-mandated world, and we'll assume for the moment that MEPs work their way out into the system, how do you deal, and I guess what's the size of those that probably won't get covered as a result of a non-mandated structure, and how do you address that segment of the market, which could be a growing percentage, particularly with the gig economy?
We focus on the medium and large size markets, so we haven't necessarily tried to draw a line. Clearly, there would be some point at which even the costs of servicing an account, if you will, could perhaps be prohibitive, or the demographics of that group just is of the type that Brian talked about. It could be that, to the gentleman's comment over here, different service providers in their offerings appeal to certain segments of the market. And through that, we've got better coverage with, some multiple employer plans appealing on the larger end and others at the smaller end. Again, we've got a cost coverage issue that we need to deal with on a transition and a go-forward basis. Again, we haven't drawn a line specifically, but we do think that there's room in the marketplace for different offerings and different service providers to fill those needs.
I think there was another question over here.
Thank you very much. Lenny Gwynn from Putnam Investments and Empower Retirement. I wanted to mention and ask you both, assuming the DC system is, as you say, Rick, here to stay, and the goal of the system is actually lifetime income for participants, we do at Empower an annual survey, comprehensive survey of people's assets and savings and Social Security and business ownership, home equity, et cetera. And we can segment the population by percentages of their ability to replace income in retirement. And you can see a ladder going upward at the median from 42% for people who have no workplace plan to 70% plus for those that do, and then higher yet into the 80s for those whose plans have automatic plan design, and higher yet still for those that have savings escalation, and for those that reach 10% or more. And there's a very significant number of people in that full package, 10 million households or so. And our conclusion is that those best practices, full auto package, high deferral rates, actually solve those people's retirement challenge. At the median, we find they can replace 108% of their lifetime income because they have Social Security equity and they have plans that bring them to that level. So the question is, if our goal is income for the participants in the workforce, what can we do to spread those best practices from, say, 10 or 20% of the system down the ladder to those firms that haven't done it? Well, could that be done by DOL guidance or leadership from the Treasury? Does it need legislation? What can we do to get people to adopt designs that we know work and are achieving the system's goal, but it's only a partial success? Can you speak to what we could do to get those best practices as wide as possible?
I'll take one shot at it, but I'm probably not as broad as Rick. I think when you're talking about where the biggest gap probably is those individuals that probably don't have companies like mine that are large and can build up the infrastructure in order to manage it. You have some solutions by consulting firms like Aon that will come up with some variations, but you probably still have a great deal of gaps where you don't have the ability to sort of set up the infrastructure. So we've heard that the states are trying to fill in that gap or thinking their best way to fill in the gap, but we see what some of the risks are with that as well. I think technology could be very interesting in this space because technology allows you to assess risks a lot more finitely. And it seems to me that as we get more and more sophisticated in being able to determine that, I mean, that is helpful certainly from my company's own risk, but I would think as you use that going downstream that products could be put together by the private sector that alleviate some of that risk. There could be you assess the risk and price it accordingly. It seems to me that there could be an overlay of government policy that could help smooth out any potential risks for things like lawsuits and things like that, where you could set up best practices. But I think you can still drive it from the public sector, but have an overlay of stability coming from the government on what is right and what is wrong.
I think the biggest thing we can do as a community is to encourage the debate about what the most productive behaviors are. And they'll vary based on the cohort. One size doesn't fit all and one size shouldn't fit all. But I think it's a discussion for the community. I think if we get into the mandate world again, it flies in the face of a voluntary system. Defaults have been found to be very effective. For the reasons that the gentleman cited, they are effective and they work. I think we need to turn up the dial on defaults and really default people into very productive activities, relying on best practices all the way around.
I think we have time probably for one more question. If there's any more questions out there? Okay, if not, I'd like to say thank you, Janet. Thank you, Rick. Really appreciate it.
And thank you to the Chamber.
And thank you to the and thank you to the Chamber for having this.
Please welcome to the stage Research Director at the Employee Benefit Research Institute, Jack Vander Hai.
Thank you. It's a pleasure to be here. I'd like to thank the U.S. Chamber of Commerce for the invitation. I'd like to thank Aaliyah even more for giving me such a concise title of my presentation, which I kind of interpret as carte blanche to talk about whatever I want for 10 minutes. What I would like to do is very quickly go over some highlights. If you have the slide packet in your handouts, I think we have about 35 slides. As far as some of the details, I just want to quickly summarize some of the overall highlights. One of the questions that we are probably being asked more than ever these days is, what's the probability that future retirees are going to have adequate retirement resources? I'll spend a little bit of time talking about the model we use, but looking at what the overall likelihoods are depending on definitions, and then break it down by things like how long people are eligible to participate in defined contribution plans. Then to spend a little bit of time looking at what's the aggregate retirement deficit for those people that we're predicting to fall short. Kind of picking up on what Brian went through earlier, what's the impact of age and employer size on participation, which sets the stage for things like auto IRAs. And one of the things we're going to look at in number 4 is how do various retirement reforms move the needle when it comes to retirement deficits. We're going to take a look at what would happen if there was a national auto IRA, for example, and compare that to the kind of retirement deficit reduction you would get under, let's say, a universal defined contribution system, and then pick up on something that basically doesn't modify anything, but tries to make the current system more efficient by having some kind of auto portability system. We're going to wrap it up by taking a quick look at just how important leakages are in the system today and how much we might be able to gain if that was dealt with successfully. Very quickly looking at what's likely to happen in the next couple of decades as far as Social Security benefits and how those reductions might impact various individuals. And then finishing up with something that we spent a lot of time looking at recently at EBRI, and that's just how important auto features are in 401k plans and how much that might improve the overall situation. Before I get into any of the specifics here, let me just quickly tell you what our model at EBRI does, and more importantly, what it doesn't do. This is not a replacement ratio model. We started doing this basically in the late 90s because governors from certain states were very concerned what would happen with respect to future cohorts of retirees. How quickly would they become financially indigent? And of course, the reason why that was important is because the states, because of Medicaid, would be on the hook for things like nursing home costs. So what we do is basically look at individuals. We have both an accumulation and a decumulation stochastic program, and basically are able to project when people are literally going to run short of money in retirement. Now, what we do here is when we're asked what is the probability that somebody currently working, and we start at 35 because it's really hard to model people younger than that in terms of what they're likely to end up with as far as job opportunities. What's the probability that they're going to have adequate retirement resources? If you include long-term care costs, some people suggest that's not the appropriate measure, but if you include that, and assume people are going to spend at 100% of average retirement expenditures for people in their income group, for people in their family status, whether or not they have a house, et cetera, we find that about 57% would have adequate resources. But if you make the, I think, very logical assumption that when people start running short on money, before they run out of money, they start cutting back. And that second bullet point, if you include long-term care costs, but assume that they only spend 80% of the average expenses for people in their particular category, we can bump that 57% all the way up to 82%. So better than 4 and 5 are going to have adequate money. If you want to ignore long-term care costs, the next two bullet points do exactly the same thing. At 100% of average expenses, you can increase that 57% up to 76%. And if you want to ignore long-term care costs and assume that they start tapering down when they get short on money, you can get up to 91% have adequate income. So again, there's a very wide range there with respect to what the answer is, but it's really going to depend a lot on whether or not you're going to factor in long-term care costs and whether or not you assume people start to taper down when they start getting short. Now, for the next one, though, I want to assume the most rigorous set of assumptions that we are going to look at long-term care costs, and we're going to assume that they spend 100% of average expenses, and focus on how pre-retirement income and years of future eligibility in an employer-sponsored plan are going to matter. I'm going to take the middle 50%, the people in the second and the third income category, as far as Gen Xers are concerned, and look that for people, for example, that have no future years of eligibility. I'm not saying participation. I'm just saying whether or not they work for an employer who sponsors a plan. Basically, we have a probability of just over half, 51%, will have adequate retirement income. For those that will be with an employer who will offer them a defined contribution plan for 1 to 9 years, it goes up to 56%. For 10 to 19 years, it goes up to 71%. And for those lucky enough to basically have eligibility for the remainder of their working career, we shoot it all the way from 51% to 79%, which shows the incredible importance of trying to increase access to defined contribution plans. Now, how big is the shortfall for those that we project are going to run short of money in retirement? If you want to assume that long-term care costs are modeled and that people will spend 100% of their average expenses, the number we come up with, again, for people 35 to 64 in current dollars is $4.1 trillion. But if you want to leave long-term care costs in there and assume that they start tapering down and they only need 90% of average expenses, we can basically cut that in half to $2.1 trillion. And if you go all the way down to 80% of average expenses, we can get that overall deficit for everybody currently 35 to 64 in the country down to only $700 billion. Now, picking up on the point that Brian had made earlier talking about CPS, we certainly agree that there are some biases here in terms of what you see for the overall coverage numbers. It's just that the alternative database he mentioned doesn't really let you go back and do some of the breakdowns. This just gives you the overall impact of both age broken out in various cohorts, and I think most importantly, employer size, because I think what most people in the auto IRA debate are trying to focus on is what are we going to do for people on the left-hand side of each of these columns for the overall participation numbers for those with relatively small employers. Well, what we have done, and I'm only going to focus here on the relatively young employees. I mean, any reform proposal you talk about other than increasing minimum Social Security benefits is basically really going to work well for the younger employees. Those already approaching retirement age are going to have somewhat limited options. But what we find for those currently 35 to 39 is if an auto IRA was established, no size exclusions. This applies to any employer who does not currently have either a DB or a DC. If you have an employee contribution of 3% and heroic assumption, you assume no opt-outs. Now, Brian talked about the importance of doing opt-outs scientifically, and again, we're waiting to see what happens in a system like this. But even if there were absolutely no opt-outs from that system, for those people that were 35 to 39, we can only get their retirement deficits down by about 10%. In contrast, look at the next bullet point. We do universal DC plans. We're not talking mandate, but we're saying if every employer had a DC plan, and they had a DC plan similar to other employers in their size group, so we specifically have small employers have somewhat less generous provisions than the larger employers. Instead of only a 10.6% reduction in retirement deficits, we can get those deficits down all the way to 28%. And the important distinction is this includes what we're finding in the EBRI-ICI database in terms of actual contribution activity for individuals and opt-out rates. So unlike the auto IRA where we assume nobody opts out, we're actually using empirical evidence, and we're getting almost a 3-to-1 increase in that overall deficit. Now, the final one, just very quickly, I wanted to touch on is something you've probably heard other people talk about in recent years, auto portability. And basically, what we're assuming here is that anyone who has literally changed jobs and has a defined contribution balance is automatically going to be rolled over into some kind of clearinghouse and then paired up with the new employer, assuming the new employer also offers a plan at a later point in time. Once you're in the auto portability system, I'm assuming that doesn't leak, but we have all the additional information in there as far as the current system and how much of a difference that can make in terms of reduction in overall deficits. We find that depending on how many years of future eligibility you have, anywhere from 17 to 23% of that deficit, that $4.1 trillion deficit, can be reduced from auto portability alone. So you're not talking about enacting a new system. This is the system we currently have, just making some kind of clearinghouse available to try to reduce overall cash outs. Talking about leakages, just how big, important are they? There's an appendix slide D1 because I'm sure what I'm going to do very quickly here is not going to make a lot of sense. But when you ask individuals basically what they should have as some kind of overall replacement income, if you look at things like 401ks, IRA rollovers, Social Security benefits, typically you're going to get something in around the 80% range. So what we did is we went back, and this was something we did for the Risk Advisory Committee a couple of years ago, and looked at, of those people that don't hit that 80% threshold, how many of them would, if you had been able to eliminate the impact of the 3 leakages, loan defaults, hardship withdrawals, and cash outs? And depending on income quartile, not surprisingly, you get more of a bang for the buck in the lowest income quartile. Between 15% and 27% of those who miss that 80% threshold would end up hitting it if the leakages were removed. Now, cash outs, without a doubt, are far more important than either loan defaults or hardship withdrawals in coming up with those overall evaluations. And the one caveat I have to mention, of course, is this is just a first-order approximation. We all know that if you limit ability to cash outs, to loans, to hardship withdrawals, you're likely going to decrease participation and decrease contributions, especially among the lowest income quartile. But at least at a first pass, we see in terms of quantifying how important leakages are, it can be anywhere from 15 to 27%. As far as reduction in Social Security benefits, we ran the Social Security trustees numbers a few years ago where we assumed that trust fund went to 0 in 2033, and at that time you start a pro rata reduction of about 24%. Most importantly, obviously, are the youngest cohort, in our case the Gen Xers, who happen to be in the lowest wage quartile. In that case, we find that if we had that situation, if their Social Security benefits were in essence cut by 24, 25%, that would decrease their probability of having adequate retirement income by 1/2. As far as overall those aggregate retirement deficits we talked about, of $4.13 trillion, it would go up to $4.38 trillion if you had that kind of pro rata reduction in Social Security benefits. And then finally, and this is the one where we have spent a great deal of time recently, and again, we, in collaboration with ICI, we've been building the world's biggest 401k database now since 1996, and we've spent a lot of time looking at what happens with the various plan designs. And we looked at those who have the old style voluntary enrollment 401k plan design. We looked at basically what's happened since PPA with automatic enrollment and automatic escalation. And based on all the results that we put together thus far, regardless of age, regardless of income quartile, we find that there's at least a 17.5% improvement in simulated retirement outcomes, basically where you end up at age 65, going from voluntary enrollment to automatic enrollment. Why that's important is there has been a lot of negative press that if you go to automatic enrollment, that some people will stay at that default contribution rate, and that might give you a lower overall contribution than if you had stayed with voluntary enrollment. Certainly, if you have automatic enrollment with auto-escalation, we find that over the entire span of ages and incomes we've looked at, you have at least a 17.5% increase going from automatic enrollment to voluntary enrollment. So I think I'm basically at the end of my time, but if there's any quick questions I could answer, I'd be more than happy to. It varies much more by age and by income. I don't have the slide with me, but it gets certainly in the double-digit range in most cases. Okay, well, thank you very much.
Joining us on stage for the congressional reaction to the Legislative Roadmap panel are Tommy Nugent, Committee on Health, Education, Labor, and Pensions; Sidney Terry, Office of Congressman Pocan; and Paula Kalamofta, partner at Paley Rothman and chair of the Small Business Council of America.
Well, the voice missed one of our panelists up here, so I will be glad to introduce him. Stephen Hostoli is, one second, he handles the pensions, retirement, labor, and Social Security issues for Ways and Means member Congressman Jim Renacci. So just because he was not introduced by the voice does not mean he's not important. And sometimes the voice gets it wrong, you know. But we are pleased to have everybody here, Sid, Tommy, and Stephen. Unfortunately, Beth Bell from Senator Cardin's office will not be able to join us today. It's too bad. I was going to have some walk down memory lane to the Portman Cardin legislation of years past, but I'll skip that since she's not here. Thank you for coming. We are looking forward to hearing your comments on our legislative roadmap. We've worked hard at the Chamber developing this. There's been a lot of man-hours put into it, and we're really looking forward to hearing your thoughts on it. Stephen, do you want to start?
Sure, I'll go ahead. First, I'd like to thank the Chamber of Commerce for hosting this event and note that all the views expressed here today are of my own and not of Congressman Renacci. Contrary to the very divisive political environment that we now find ourselves in, many of the proposals put forward in the legislative roadmap already enjoy broad bipartisan support in Congress. With retirees living longer and longer, it will be important for Congress to work together to take steps to help Americans better save for retirement and to ensure that businesses can operate within an environment that allows them to provide retirement benefits to their employees. I'd like to briefly discuss a few proposals that are within the roadmap that have received bipartisan support that I've had the ability to work on the last few years. First is the Pension and Budget Integrity Act that was introduced by my boss and Democrat Representative Mark Pocan in the House and by Senator Enzi in the Senate. This simple legislation would prevent the premiums that businesses pay to the PBGC from being used as an offset for unrelated spending. This legislation has gained the support of numerous business organizations, including the Chamber and labor unions, which just highlights the important need for this legislation. In recent years, Congress has increased the premiums that businesses pay to the PBGC in order to offset increased spending in various spending deals, most recently in the BBA that was signed into law in 2015. First off, this is very bad budgeting. These premiums go towards the PBGC in order to pay benefits to participants, meaning that these dollars cannot be used for other federal programs. Second, continuing to raise premiums, particularly on the single employer side of the PBGC, diverts dollars away from further investments, job creation, and providing further benefits to their employers. For retirees and employees, this makes it more difficult for their employers to provide defined benefit plans. This legislation does not prevent Congress from raising premiums, but instead ensures that Congress is only raising premiums when necessary, not when additional revenue is needed. The most recent PBGC report released this past November showed that the single employer PBGC program will show a surplus in 2025. Congress needs to be mindful not to push employers away from the DB plans by further hiking premiums when not necessary. The second initiative that I wanted to briefly touch upon in the roadmap also has seen broad bipartisan support, which would allow small businesses to join together without an employer commonality in a multiple employer plan, often called open MEPs. This idea was included in the Senate Finance markup that took place this past fall and received unanimous support within committee. On the House side, Representative Buchanan, along with my boss, Representative Kind, and Representative Neal, introduced this similar legislation right after the markup, and this legislation will actually be reintroduced in the House today or early next week. This common sense proposal will make it easier for small businesses to come together and share in the administrative expenses of providing a retirement plan. A recent GAO study found that about half of private sector workers in the U.S. lack coverage from a workplace retirement savings program, primarily because they don't have access, particularly from small employers. Past few years, Congress has come close to moving this legislation. I hope that this is the year we're finally able to do so. I applaud the work in the Chamber in putting together this document and advocating for policies that will help lead to better retirement outcomes, and I'm happy to answer any questions you guys may have.
Thanks, Stephen. Tommy?
Thank you to the Chamber for having us here to discuss the legislative roadmap that you guys have put out. And I will also note that what I'm about to say here are my own opinions and not attributable to my boss, Senator Johnny Isakson. I commend the Chamber and many of you in this room for being champions of retirement benefits and expanding incentives, encouraging both employers and employees from participating in retirement benefit plans. Big elephant in the room being tax reform and when and how that happens this year. I'm sure is on many of your minds. We look forward to seeing how some of the proposals you've put forth in the legislative roadmap become incorporated in tax reform as both the House and Senate start taking that up later this year. Some of the priorities that we have looked at both on the committee where my boss sits on, Help Committee and Senate Finance Committee, include preserving a lot of the incentives that are already in place, ensuring that financial advice opportunities are preserved. Most notably, the fiduciary rule, as my boss has come out multiple times and very recently said that it is especially onerous on plan participants and plan providers, extremely limits advice, and we are encouraged by some of the news being reported this morning that the White House plans to take action on that. That being said, we look forward to working with partners on both sides of the aisle and both sides of the Capitol in whatever the roadmap looks like moving forward. Thank you.
Tommy, I know this probably has already crossed your mind, but when you think about tax reform, the House blueprint was very brief when it came to retirement incentives. It did say that the current tax incentives would be maintained, and that is really, really good news because everyone in this room knows the only reason why the voluntary system works as well as it does, particularly in the small business area, is because of those tax incentives. But another thing that's working really well with the system is flexibility. And there was a clause in there about designing more efficient and effective plans, and that's the kind of language that gets me really scared personally. So I'm hoping that flexibility will be maintained. And I'm all for simplification, but I like optional simplification. So the 401k safe harbors to me were brilliant in that area where if a company wanted to adopt them, great. If they didn't have to. And rather than mandating something like that, which would cause a tremendous amount of extra work in paperwork, notices, all that kind of stuff, it was bypassed by making it optional. And I think that's one of the reasons it works so well. So.
I would agree with that. Flexibility, options, incentives, and not mandates are really kind of the road forward, and what I think we would support.
Well, I know the chamber would support that for sure. Sid, how about you? How did you react to our roadmap?
Thank you very much, Paula. Again, I guess I'll have to echo this, and this is kind of the Hill staffer go-to. These are my views, not the views of my employer, my boss necessarily, though I don't know that in some cases he may agree. I actually thought this was a really overall strong proposal. A lot of good stuff to take away from it. Particularly, I was really glad that you started off by mentioning the Pension and Budget Integrity Act, which my boss and Mr. Anasi reintroduced this week and has enjoyed the support of the chamber and of a lot of different groups. You may also know that there's a number of labor unions that also support it. And that was kind of where my boss got interested in this issue. There was a labor management negotiations ongoing, and I can't remember if it was this most recent time where we raised premiums as part of a budget deal or the time before that, but either one, it happened, and they were kind of coming up to the end of the bargaining, the end of the line. They were really close to an agreement, and these raised premiums, which again were not actually mandated by anything other than Congress's desire to want to spend more money elsewhere, forced them to kind of have to go back to the drawing board and renegotiate some stuff. And my boss didn't think that that was right. And so when we were approached by Mr. Anasi on introducing it, we thought that it made a lot of sense for a number of reasons, and it was a great bipartisan legislation to take up, and something that you don't hear a lot in the press, but there's instances and different stuff like this that happens all the time. A couple other things I flagged that I said I thought were really good within the roadmap. I thought the small business tax credit increase would be well received by probably both sides of the aisle. Additionally, the increasing small business voice on different retirement advisory councils, again, I think that's something that makes a lot of sense. Same with the electronic delivery standardization across all agencies. That makes a ton of sense. I took a little bit of issue with the multi-employer pension reform part. I would note that the chamber was a pretty big proponent of the TARP program. I think that failure to acknowledge that the economic downturn played a large role in the challenges that multi-employer pensions face
To quote my boss, he'd often say that, when the economy catches a cold, the building trades catch pneumonia. And failing to recognize that, I think, is unfair, and I would be very interested to hear the rhetorical arguments for how you can get to that position. Lastly, I just wanted to this is a comment I make to a lot of different groups on tax reform. I think it's terrific that they're looking at it. It's particularly with our business, with our corporate rate. I think that we have what is in effect a very high rate that collects very little money, which is the definition of what a bad tax is. So anything that we can do to try to address that and make it more efficient, I think everyone would probably agree that's better. I wonder about the seemingly partisan nature of a lot of the ways that they're going about it at present. I know that there was a Ways and Means Republican retreat where they wanted to talk about this. I think that when you're dealing with something as large as tax reform, I think that it probably is going to need bipartisan consideration. I'd also point out the really significant challenge that I find when I sit down in meetings with groups from, let's say the grocers, all kinds of groups across the spectrum of the economy. They always kind of say the same thing. They say, we strongly support comprehensive tax reform, but let me tell you about LIFO accounting. And so, I think that's really has to do a lot to do with the challenges that we're going to be facing here. And I just always kind of like to temper people's excitement by sharing that anecdote. I'd also just add to that one thing. If you think about the Affordable Care Act, I know that it's not popular in this building, and I don't know how people in the audience necessarily feel about it. But in order, healthcare system is about 17% of the economy. And in order to pass it, you needed a historic majority in the Senate, a historic majority in the House, and you still barely pushed it over the line, and that was 17% of the economy. The tax reform actually deals with, at the end of the day, probably about 100% of the economy. So I would just note that the challenges are pretty great there, but we would love to see reform take place. Like I said, at present, it's hard to call the current state of affairs anything but a bad and inefficient tax. The last thing I wanted to note that I was, disappointed not to see in the Chamber's proposal, and perhaps there are ways to address this, but they weren't kind of talked about head on, was the dramatic expansion in the phenomenon of employees who are classified as independent contractors. We've seen that amount basically, I want to say it's 10 times increased in the last 15 years. And so, I don't know if you guys have seen, there's a proposal in the state of New York to try to deal with this. It's a little bit more related to just kind of the Uber type of situation. But again, the phenomenon of independent contractors is happening across the economy. And the proposal in New York basically says that in exchange for a 2.5% contribution towards health and retirement security, then you therefore give up lifetime rights to collectively bargain or to seek collective action against your employee. That doesn't seem like a great deal to me. And again, I think that not confronting this issue of the fissured employer-employee relationship is kind of really a huge missing piece. And I think that it's something that you have to really think about going forward. And I'd be happy to take any questions.
Well, thank you, Sid. While we're talking about New York, that gives me a segue into state-sponsored retirement plan legislation, which is of some concern to the Chamber, and it is in our legislative roadmap. We are concerned that as different states have different mandates or different programs, and they are preempted by ERISA, not preempted by ERISA, we could end up with just a complete mess out there. And I think ERISA preemption has stood the test of time very well, and it's important that it be maintained. So during tax reform or whatever, if there's a way that Congress can explicitly preempt state-mandated retirement programs, I can tell you that would be very helpful for many people around the country, because I think these state-mandated programs are going to really end up hurting the retirement system, particularly in the small business area, where I think the thought is it will help small businesses, but my view is it will not. Why don't we open this up to questions, and if there are not enough questions out there, then we will keep talking amongst ourselves, unless you all have reactions to each other. None, huh? Okay. You've said it all. Any questions so far on what we've discussed?
The discussion on independent contractors. Just as an FYI, I was an elected delegate to 2 White House conferences on small business. One of the conferences said, let's have clear lines as to what an independent contractor is. Never was able to get it passed through legislation. So the small business community would be better off if we had clear lines. I think a lot of us operate under the 20-point test, but states also have issues on what they view as an independent contractor, so I think we need some coordination, but I think we in the small business community might be happy to work with you on that issue.
That would be terrific. I'd be happy to give you my card afterwards and set up a time to talk about it. It's something, like I said, my boss thinks about, I think about, and that I think really is going to be one of the persistent challenges of retirement security. I didn't say this, but when you're an independent contractor, you don't pay payroll taxes, and I think that sounds good. I know I've heard I think Grover Norquist often say that when Democrats complain about about independent contractors and stuff like that, he says it's because we don't want anyone to be their own boss. I think that's really far from the truth. In reality, I think that we have a lot of fear of the administrative burden of being an independent contractor and who it falls on. In cases where people are well compensated in their role as independent contractors, that's terrific. But in many cases where they're not, again, that administrative burden is overwhelming. And like so I said, we'd look to try to make sure that our incentives are lined up and the laws make sense for everyone.
First of all, thank you both. Thank all of you. I want to commend you for the legislation that prevents or would prevent PBGC premiums being raised for extraneous issues. And I say that because I think it embodies a principle that we hope is threaded through the entire process of tax reform. And that is that the savings of the American people and the incentives that encourage those savings should not be pitted used as a pay-for other means of lowering taxes elsewhere or expanding spending elsewhere. We fundamentally believe that personal solvency and national solvency reinforce each other, and they shouldn't be pitted against each other as they were, for example, to some degree in the Camp proposal a couple years back. Every dollar in those accounts is one less dollar that person will ever draw from the federal government in the future on a means-tested basis. And all those dollars form the lifeblood of American capital markets and can contribute to economic growth. Scoring today doesn't really take account of either of those. And I'd like you to comment on the general principle that retirement savings should not be a targeted pay-for in a larger tax reform.
Sure. I think you said that very well, and I was in a meeting just a few days ago in which we discussed that very issue, in which oftentimes in DC we talk about the 10-year scoring window. Well, when it comes to retirement savings, obviously that's a much larger window that we need to look at, especially as workers continue to work longer and longer and have to rely even more on their own retirement savings. So we need to, I think you're right, in tax reform, make sure that the pay-fors aren't being used within that 10-year budget window when there are are many more considerations that we need to take when it comes to making sure that we have flexible retirement plans and that the various different type of retirement options aren't being taken away just for the sake of a pay-for or for streamlining the process.
I would agree with that. I think that incentives that are out there, and as they're scored as we move through these various proposals, really the cost of retirement savings are really investments into our national solvency, like you say. As we encourage individuals to save for their own retirement, that's one less dollar we need to spend on another social safety net program. And spending that we have on entitlement programs is just another part of that larger calculus that we have to consider as we continue to move forward.
I think that's a critical point that's just been made, and it's also, if you used a 20 or 25 or 30-year budget window, those numbers would look remarkably different because every dollar that goes to the retirement system comes back out and gets taxed. So even though it's commonly referred to as a tax expenditure and the same as other tax expenditures where the money is never taxed, that's not at all true in the pension area. And sometimes I think that's forgotten, and the 10-year budget window kind of makes the numbers look a little different than they really are. Randy, did you have a question?
Just curious what you guys are hearing. It's right behind you. Obviously George Bush in his second term came in and made Social Security his top priority, and it went. We know where it went. And I'm talking about the third leg of the stool, right? So what do you got? Entitlement reform, everybody talks about it, no one ever does anything. What's the latest? I mean, and Trump has indicated no desire to revisit or visit at all entitlement reform. Any hope on Social Security reform in the next 4 years? What are you guys hearing on up there?
I mean, I think that I'll say this is the one who's doesn't have the conflict within my party on the issue. No, but I think the president, I mean, he made that point a lot. And, at the same time, Speaker Ryan said repeatedly, immediately following the election that everything was on the table, that they were looking at Medicare reform. I haven't heard Social Security talked about. I think that, my estimation would be that that there's still enough people around with the scars to show for the last fight, that there may be particular hesitation there. But I haven't heard anything other than the budget. I think it'd be interesting to see what comes out of Chairwoman Black's budget.
I think you said it right in the beginning that the president has indicated that it's not an issue he wants to really tackle head on in the beginning of his term. But Chairman Johnson did put out a discussion draft, or actually he did introduce legislation at the end of last Congress that was, I think, a good starting point to start the conversation on what Social Security reform might look like, because we have to do something in the next 17 years or you see dramatic cuts across the board. And unfortunately, the longer that we wait, the more expensive it becomes to actually address the solvency issue. So I hope that the conversation continues on the issue and that eventually we're able to make significant progress in the coming years.
I would agree with that. I think that while the president may not want to address it, I think that the Congress has a responsibility to look into it. Like my colleague said, there is a pressing need to address the situation considering the solvency of the trust fund. The Senate Finance Committee's working groups from last Congress did put together some comments in that particular space. And we look forward to, I think, continuing to investigate the issue.
Before we, Leah.
I'll just take a minute. I want to thank all the panelists. As y'all noted, the Chamber's worked with all of you and appreciate your support and help on various issues and look forward to continuing that effort. I just want to respond to a couple of comments that Sid made. On the sharing economy, I agree. As we noted earlier, this isn't a complete document. There are obviously things that will come out, and that's one of the things we're looking forward to continuing to work on. We do have a speaker later this afternoon that's going to highlight some issues that we hope to delve a little bit more into and have further discussion about, and look forward to working with you and other offices to tackle that issue, because we do want to expand retirement security for everyone. On the multi-employer issue, you are right. The Chamber did support the TARP program. I will highlight that one feature of that program is that the money would be paid back and was paid back. Central States has said they cannot pay the money back. So it's a very different type of situation when you're talking about that. Having said that, to your point about tax reform, I think multi-employer reform will also require bipartisan work and solution. So look forward to working with you on that as well. And just want to throw it out to Stephen and Tommy if you have any comments on the multi-employer issue.
This is an issue that hits our district particularly hard back in Ohio. I think it's the second most impacted district in the state of Ohio when it comes to the Central States issue. And my boss sat down with the individuals who are going to be impacted multiple times back in the district, and to hear their stories about having their pension potentially cut 50, 60%, it's nothing short of heartbreaking. But we do need to make reforms in that space. I think that Education Workforce Committee has started that conversation. And again, we have, when it comes to the multi-side of the PBGC, their solvency runs out within the next 10 years. So again, our hand's going to be forced to make some sort of compromise, and I think you're right that it does need to be a bipartisan solution.
I think that the need to address the multi-system, at least the Ed Workforce Committee made a great step in the right direction 2 years ago with MEPRA. And it's very much entwined into that other proposal that you have in your roadmap, which is the PBGC equity issue. They are very much intertwined, and I think that you can't do one really without the other. They're very much dependent on one another. And the longer we wait, the more dire the situation becomes for both the multis and for the PBGC.
Leah, go ahead.
Paula, I don't mean to hog the floor, but I do want to offer...
Your last point was really well spoken, so keep going.
I do want to offer you a very brief sort of elevator speech on the scoring issue. And it goes like this. Consider two transactions. In the first one, you give me $1 and I keep it. That's an expenditure. In the second one, you give me $1, and 2 weeks from now, I give you back $1. That's a deferral. Are those two transactions exactly alike? Obviously not, but they would be if you had a 10-day window.
Exactly right. So, Leah, I'm a little confused because I don't know if our panel discussion should be ending now or in 17 minutes, as the clock tells us in front of us. Now, that's what I thought. Well, but we'd be happy to keep going if you wanted us to. Thank you all for coming from the Hill. We greatly appreciate your time and your thoughts, and thank you for reading over our legislative roadmap. And I know I could speak for all the chamber members that we would love to work with you on getting a lot of this through. So thank you very much.
Thank you.
Okay. Thanks for reconvening. So our panel is going to focus on three main topics. One is the changing demographics of the American workforce, the challenge that brings, and also what the private sector is doing to target those challenges. We have a very distinguished panel. I'll present them by order of presentation. First is Ms. Snezana Zlatar. She's Senior Vice President at Prudential Retirement. She leads the product development, product management, pricing, underwriting, and proposal management functions for their full-service business. Her presentation is going to focus on she's going to give us an overview of the trends in the workforce. Second will be Ms. Asha Shrikantia. She's the Director of Product Management at Fidelity Labs, where she leads a team, internal R&D group, that creates new adjacent businesses for Fidelity Investments. Her focus of her presentation is going to be student loan debt and the impact that has on workers. Third, we have Robin Lena. She's Executive Vice President at MetLife, where she's the head of the Retirement and Income Solutions, which is MetLife's institutional retirement business. Prior to this role, she was Chief Risk Officer at MetLife. She's going to talk about the tools that MetLife is developing for employers
to help workers achieve financial wellness. And fourth, we have Ms. Stacy Dion. She's Vice President for Corporate Public Policy at Boeing, where she's responsible for developing and implementing government relations strategy on a number of corporate issues, including tax, benefits, financial services, and workforce training. She's going to focus on what employers are doing to assist workers. You'll remember, most of us will remember Stacy. She had a very distinguished career in public service, working for Speaker Boehner and working also for the House Education and Workforce Committee. So I'll start with our panelists, and I'll start with Ms. Nazana.
Thanks very much, Jorge. Thank you. I'm very glad to be here today and talk about a topic that I'm very passionate about, financial wellness. I would like to talk to you today about how we at Prudential define financial wellness, what do we think is driving the need for financial wellness for individuals and for employers, and then finally how we are addressing that. So starting with the definition, I think we all know in this that there is probably more definitions of financial wellness floating around than there are providers in the marketplace today. And actually, even more importantly, I would venture to say that each of us in this room has a different perspective on financial wellness. And that depends on who we are, where we are in our life stage, what goals and challenges we have. So at its core, financial wellness is a very personal topic, emotional topic, and really varies by individual. The definition of it varies by individual. It is probably simply said, financial wellness is about having ways and means to live a life of purpose and balance at its broadest. And that's what we had in mind at Prudential as we were coming up with our definition of financial wellness, because there is no one, we haven't heard one across the industry. To that end, we really believe we define financial wellness as helping individuals adopt behaviors that will enable them to do three things. Number one, effectively manage day-to-day finances. Number two, achieve long-term financial goals through savings and investments. And number three, protect against key risks, such as disability, loss of jobs, critical illness, and so forth. And we really strongly believe that all three pillars are equally important for individuals along their life cycle. And that's why we're developing a set of solutions to address financial wellness and make a millennial, for example, educated enough to manage finances effectively and pay off student loan debt, to help family who is in their 40s expand the house as well as save for kids' education and maybe protect against critical illness, to make sure that the retired couple does not outlive their assets and maybe have enough money to start their second act. So that's the idea. But in reality, when we look at what's happening today across America, we know that millions of Americans are struggling with financial issues. There is numerous data on that, and I'm sure many of you have seen that over 40% of Americans do not have 3 months' worth of emergency savings. We heard about challenges regarding retirement security and savings even today, earlier in someone's presentation. So to expect from an individual to figure out how to achieve financial wellness on their own is really very, very difficult. There is a plethora of offerings, financial offerings out in the marketplace. There are dozens of providers. An individual cannot easily connect the dots to figure out what are the right solutions for them at that particular time. So it is no wonder that we hear today from over half of the Americans that they have very low confidence in their own ability to make financial decisions. But there is good news also. some of the latest surveys showing us that about 60 to 70% of employees actually trust their employers to help them grow and protect money. And therein, I think, lies a tremendous opportunity and responsibility, I think, for our industry and for employers at large. And I know Stacy will talk more about employer dimension, but I can just very briefly provide some information, at least that we have, why employers care about financial wellness. Well, again, research shows that 25 to 30% of employees today are concerned about their finances while at work. Probably 60 billion or close to 60 billion is withdrawn early from retirement savings, which is about half of employer matching contributions. Over 40% of people today are planning on delaying retirement, and some of our studies that we have done at Prudential show that every year of delaying retirement costs an employer another 1% to 1.5% in more in benefits. So in conversations with our clients, employers, and employers in the marketplace, I think we see a sea of change. We have been, as an industry, talking for a long time about retirement outcomes, right? So, but it is clear now that on this path to retirement, there are many events that happen that can derail an individual from saving for retirement rather. And to that end, we see that employers are realizing the same thing. They're realizing that there is really a connection between employee financial wellness and their productivity and engagement in the workplace. And their goal, as always, will be to attract and retain the top talent, but also their goal is to do that while optimizing their benefits spend along the way. So that's why, again, at Prudential, we have developed this three-pronged approach to help employers address financial wellness and therefore help their employees in turn. First part of that is we help them discover needs of their employee base. So there is that diagnostics of financial wellness from both individual perspective and employer perspective is really important part. Second, based on that, we help employers design a set of solutions that is configurable for their unique benefit strategy and their needs. And then thirdly, probably most importantly, we help them inspire employees to take action, engage employees, because without that, the best programs are just sitting on the shelf, and we know that oftentimes offering more does not lead to better outcomes. So that engagement strategy, that combination of diagnostics, solutions, and sophisticated engagement strategy, and technology plays a huge role here, is what we believe is a winning combination, and we're hearing a lot of interest in the marketplace for that. So just in conclusion, I would say that financial wellness is a long-term strategy for Prudential, and because it is fully aligned with our mission to ensure long-term financial security for millions of Americans. We think it's a win for employers because it will enable them to, again, attract and retain best talent and optimize their business model while they're doing that. And then finally, it is a win for employee because they will have somebody, finally, a plethora of targeted, not just education, not just tools, but also solutions that will be able to meet them, again, along their life cycle and deliver the right outcome for them. So.
Thank you very much, Nizana. Asha?
Sure. So thank you very much. I feel very honored to be here. As was mentioned, I work in a group called Fidelity Labs, which is a new product development group within Fidelity Investments. And for almost 2 years now, I have been almost solely focused on the problem of student loan debt and how it impacts our employees, our participants, and our customers. So student loan debt, it's hard to not know about the staggering state of student loan debt in our country right now, especially given all of the media coverage that it got last year on the election trails. So it is a $1.4 trillion problem in our country right now that's affecting 44 million Americans. It's the second largest class of consumer debt, so larger than credit cards, larger than car loans, second only to home mortgages, and the rate of growth is incredibly fast. So last year's graduating class, the class of 2016, graduated with an average loan balance, student loan balance of $35,000. And that was up from the previous year where it was only $32,000. So that's the rate of growth, that's the rate of acceleration that we're talking about in this space. So with these trends, at a company like Fidelity, where we know that we're focused on long-term savings, holistic financial wellness, it was pretty hard for us to ignore the fact that this was very much impacting a huge swath of people. So we wanted to understand how specifically is it impacting our people. So over the course of the past 2 years, and now 2 years in a row, we have conducted a workplace survey representative of plans nationwide, representing all geographies, representing all plan sizes. And what we have found is that 1 in 3 Fidelity plan participants currently have student loans. One of the most surprising aspects that we found was that it's not just a millennial problem. So I think it's very easy to think about, oh, it's just 20-year-olds who have student loan debt, and by the time they're in their 30s, it's done, it's okay. That's not the case. So 59% of our participants under the age of 40 have student loans. But 34% of people between the ages of 40 and 54 have student loans. 23%, almost a quarter of people aged 55 and over have student loan debt that they're still paying back. Over half have loan balances that are over $25,000. So again, pretty significant debt balances here. But behind all of these numbers are real people. They're people who work for our company, work for companies that we work with. And I think that what we have found in literally hundreds of hours of talking to people with student loans is that student loans don't just present a financial problem, they also present a pretty significant emotional problem. So for an individual who is paying, let's say, $1,000 towards their mortgage every month versus $1,000 towards their student loans every month, the way that they feel about their mortgage is, yes, I'm taking a step forward in my life, I have an asset that I live in, it feels great, versus the $1,000 that they're paying towards their student loans, it feels like it's the thing that's holding them back, preventing them from going forward. These themes are consistent across generations, these themes are consistent across geographies, and are perhaps best summed up by quotes from real people. So from a millennial, student loan debt makes it difficult to take chances in life, like find a new job, get married, move to a new city, or buy a house. It just brings a lot of fear and uncertainty into your life. And from a boomer, I would be in good financial shape and able to save for retirement, I'm 56, if I didn't have to continue to pay off my student loan. As it is, I will die owing money and will not be able to retire at 65 or even 67. Not a happy prospect. So what are we doing about it? Well, right now at Fidelity, we're really tackling this problem from 3 different fronts. So the first is for loan holders. We've developed an online platform that's really focused on empowering loan holders by providing financial literacy and education. A lot of people who graduate with loan debt don't understand the basics of how those loans work, and they don't know that they actually have options in paying them down. So what we do here is we show people not just vague and abstract information about loans, but actually, hey, here's your loan picture. Here are your numbers. If you were to enroll in a federal government repayment plan, here's what your life would look like, and here's your new monthly payment. If you were to privately refinance your loans, here are the pros and cons for you. Here's what your new lifetime cost would be. Really making it tangible, tactical, and relevant to the people who have this loan debt. That's a platform that we have been piloting for the past 6 months or so, and we're about to launch it more broadly on Fidelity's broad financial wellness platform this spring. As an employer, though, Fidelity's been a pioneer, really, in the space of offering a student loan subsidy. So some of the loudest voices kind of expressing the stress of student loan debt have been our own employees within Fidelity. And last year, right around this time, we launched what we call the Step Ahead Student Loan Assistance Program. So through that program, Fidelity offers $10,000 over the course of 5 years to employees who are under the director level at our company. Within months, 6,000 employees had signed up for the program, and we're already seeing that it's creating a positive impact on both attraction and retention within the company. And so we're now looking at ways that we can actually bring this same type of offering to some of our clients and beyond. But then for families, so I think we all realized and recognized through all of the research that we've done that a lot of the problems associated with student loan debt stem from decisions that families are making when people are 18, 19 years old. The truth is that the rules of the game have changed so much since parents themselves were selecting a college to go to, and a lot of families find themselves in a position where they don't really have any trusted sources to turn to find proper financial information us alongside with all of the other sort of factors that you think about when choosing a college. So what we're doing here is really bringing discovery and price transparency to the college shopping process, again, through an online and mobile vehicle. So this is in early stages of exploration and development right now, but our goal is truly to develop a platform that helps people select the right college for them, but also helps in a way that no family has to take on more debt than they can comfortably afford. So again, thank you. I look forward to sharing more data that I have on the direct impact between student loan debt and retirement, but I think I'll keep that for the Q&A part. Thanks.
Thank you very much, Asha. Please,
Okay.
Robin.
Hi, I'm Robin Lena from MetLife. So I'm going to try to touch on some of the themes of the first two speakers and then add more depth about some of the tools, our insights and tools in the financial wellness space. But I think if it'd be helpful for you to know where MetLife derives its perspective. We've been committed to financial wellness about 100 years. There actually is a company ad that's dated 1917 that is a reach out to employers to help their employees with their financial wellness. I always thought that was kind of funny how things come around. And our perspective is derived from several sources. We do an extensive amount of research, and we publish a lot of studies, but we do research into individuals and consumers and also employers. We have a global employee benefits franchise, and the MetLife Foundation also gives a significant amount of money in this area, particularly around financial inclusion. Our business is we're the largest commercial insurance carrier in the United States, non-medical, and we have a huge client base. We have as customers about 50,000 companies, 92 of the Fortune 100 and about 80% of the Fortune 500, just so you have an idea of our reach and the pool from which we can derive insights. There's like 40 million employees that we can touch. And so it's, from this information source, we've been doing a lot of reflection. We have some programs in flight, but we're evaluating what would be the right fit for more programs to roll out. So it's from that perspective that what you hear a lot about wellness. It's become one of the more new overused words, and it'll be different kinds of wellness. It may be total well-being. You'll hear about health wellness programs. Companies will have things about getting more fit. There may be meditation, bikes to work, and that kind of stuff. And then you'll also hear about emotional and financial well-being. And we define financial wellness in particular into 4 components, a little different than Prue, but the 4 components are financial awareness, financial health, financial security, and financial inclusion. And we believe that there's elements of all 4 of them. You get the total picture, and that would drive the solutions and tools and how people would access that information. But similar to Prue, we believe that those people who can access an employer benefit program or a group-provided program, so the MEPS type of concept, would gives you a platform like that. They view that as an important safety net and an important environment by which they can access these elements. So financial awareness is just education and practical application of the basic concepts, so people understand what do they need to deal with. It was interesting, I was listening to Asha, your point about to have people think about a student loan as the lifetime cost of that obligation. I thought that was actually pretty cool. Financial health was enable the management of your day-to-day finances, unplanned expenses. Most people, as Nizana said, most of us live paycheck to paycheck, regardless of how much money we may make. Financial security is kind of the next step in the chain that promotes the planning and savings for the futures. And you can create either life events or life stages or milestones that can manifest in different ways. And then financial inclusion is the access to these products and services to be able to achieve financial wellness. And often financial inclusion would be focused most particularly on those who cannot access this, lower income or people who are disadvantaged and may not have access to a workforce environment. So if you think about the tools, the context you have is various perspectives, because there's the employer perspective, and I'm curious to hear from Boeing, is from the company culture and employer attitude about how much they want to provide, whether they're paternalistic or not, whether or not they feel they want to make available the workplace as an access point, whether or not they provide the benefits. And then there's also individuals, and Snezana talked about, we're all different, right? We all have different needs and such like that, about what you want, but you also have different desires how you want to access it. So it's not an easy nut to crack, and so you have to dip into several different pools to try to get an offering that would meet all these needs. And it would be, do you have high touch elements for those of us who are in later generation, boomer generations or high tech or mobile access? And so on the high touch front, MetLife has a program where we provide workforce seminars at no charge. And we're mindful of the evolving regulatory environment about being able to provide education and advice. But workshops, the on-site training, you could see that type of, whether it's one-to-one or in groups, but that is evolving into remote advice or maybe even robo-advice, but people could get the basics of day-to-day planning and maybe more evolved college fund estate planning, retirement planning kind of. It's typically targeted at people who are near retirement within 5 years or whatever we think retirement age is these days. Like I said, we have a program that's called PlanSmart that 450 companies currently use these programs at their work site. Now, if you shift gears to more high-tech offerings, these are what companies are trying to find ways to disseminate information either through online, do-it-yourself tools, which may be text, mobile kind of. One type of program would be what Hello Wallet does, that there's not software. People feel it's not overly difficult for them overly burdensome for them to at least think about what they have, get some information, and start to analyze their stuff, maybe simple day-to-day cash management, and then maybe more evolved. But it's interactive, it would be digital. And I think the challenge that people are having with building more on this is how do you get the seamless interaction from your bank account information, whether it's Mint or that kind of stuff, to other sources of information that you may want to include. It may be your benefits info, your employer provide other forms of compensation with if you have an investment portfolio or other kind of stuff. The mobile delivery of that is of most interest, particularly for Generation Y and Z. And what's interesting there is to try to get it to the use of gamification, where you've got marketing, social media, interplay into that, and you can look at, it's what information you want to get on your iPhone. So it's, this is the space of work that we're looking at. I think that the early challenges we're finding is that they want this information, but they don't want to pay for it. They think it should be provided free. And then while people want the ease of getting stuff at the workplace, they may not trust the environment entirely in terms of providing all their information. So there's a number of challenges. We're working, with individual employers. Most of the interest tends to be on large and medium-sized employers to find the right intersection of those things that people could either get packages that are bundled for those who want the gold, platinum, or silver package, or those people who want an unbundled, they want to select those elements that are most convenient for them. So,
Thank you, Robin. Stacy.
Hi, thanks very much, Jorge. Thanks for having me here. First, let me tell you a little bit about Boeing. We celebrated our centennial last year, which we're very proud of. We have 3 separate businesses. We are a $100 billion company, close to it. We have 3 separate businesses: Boeing Commercial Aircraft, Defense, Space and Security, and Global Services, which is coming online fully operational in July. And although we are a global company, the majority of our workforce is actually in the U.S., over 160,000 employees, and we're very proud to say, coupled with our 17,000 suppliers and vendors, we put $1 billion into the U.S. economy each week. So when I first got to Boeing, the thinking from our benefits and strategy was really around retirement security, and then that evolved into financial well-being. And now we are, it's an engineering company, so it's, streamlining, taking costs out of the system. Now we're looking at it in just one well-being strategic vision. So this would be a global strategy with a local approach based on a consumer-centric design. So really, we want our well-being program to be holistic, encompassing all aspects of health, lifestyle, and work-life balance. So that includes one program addressing physical, emotional, and financial well-being. So our rationale is to, obviously, this is increase productivity, and that's through reduced financial stress. We talk about it in terms of giving our employees the financial courage, meaning having employees empowered to make better financial decisions, and coupled with that, retirement income aligned with needs. So we have 3 priorities that we're working on. I know there are a lot of providers in this room, and Fidelity touched on one of them too. First is higher education. It's our first priority. Priority number 2 is healthcare. And then priority number 3 is continuing to build on our financial planning and protection. Now, what we're doing right now, as you can imagine, in the health space with chronic condition prevention, biometric screenings, lifestyle coaching, emotional well-being, managing money and debt, budgeting, debt reduction, lifestyle management. I'll get to the student loan part. Growing net worth, building equity, investing, but we also need to address the protection of assets too. We do have longevity protection, but we are also looking at whether it's insurance or estate planning or long-term care as well. And that's in our second priority. So now, with respect to higher education, we need to address the multi-generational challenge relating to financing higher education with a comprehensive program focused on 3 areas: student loans, saving and planning, and what we call college coaching. And there's a business case for this. 28% of our workforce has student loans. Now, and I'll tell you this, half of our workforce is eligible to retire right now. So that should give you some perspective. 50% of our workers with student loans worry about saving for the future. And 80% of those say that it impacts their 401k participation and savings rate. With respect to the millennials, obviously since half of our workforce can retire right now, we're very focused on the next generation. And 13% of those say that they are more likely to accept a job with if student loan repayment is offered. And 36% of them say that they would stay a minimum amount of time if their employer provided a student loan repayment benefit. That's interesting. So our next steps include a Student Loan Hero program, which is a free tool with calculators and loan options, and to educate employees and dependents on student loan repayment options. As well, that's on the front end, and then on the back end, a student loan tool payment provider to enable loan repayment options. This is really to reduce financial stress and increase productivity. Now, Congress needs to catch up with this a little, with allowing our matching contributions on that side. There is a bill out there. It needs a little tweaking, but we are very supportive and would like to see that addressed this year, because that is one of the barriers we see to creating a program. Right now, non-electives you can do non-electives, but look, as an employer, there's a pie. The pie is not growing, so we need to focus on refixing what is the components of that pie. So, with respect to the higher education, the business case, we did our survey. 73% of parents with children under 19 cite paying for college as their #1 financial concern at our company. So we are going to introduce a 529 tool, and again, this is all around the reduction of stress and increased productivity. Because look, they're researching, they're going to spend less time hopefully researching plans at work, and that's important to us. Our pilot, and we're also doing a pilot college coaching program, and this is to fill in any gaps from high school guidance counselors, similar to what Asha was mentioning too. And measure our results to shape decisions. So moving on to our second priority, in the interest of time, this is to help our employees with care. And this, when we talk about care, we're talking about everything from child care to elder care to long-term care. We also want to align our HSAs with the 401ks with respect to investment advice and for options for investing and advice. There are regulatory barriers to that, including how you pay for it. So some of our staffers are still out there. We'll be talking to you soon about that. And of course, planning and protecting with a financial coach, advisors, and budgeting and tools. And this, again, gets to everything from your debt and credit to estate planning to decumulation insurance. So that is our 2020 vision. And I'm sure, like I said, we have a lot of providers out there that will love to talk to us about how we take all of this and streamline it. And I'll give you an example of a problem that we have just today. We offer, as you can imagine, soup to nuts, a lot of different programs, but there's a lot of noise out there and a lot of confusion. And we even had one worker ask us, can I just text a question? I'm not in this program, this huge advice program, but I do have one question. Who can I text? And
like a genius word.
Yeah, and we don't have that. So we need to reduce the noise and just provide a simple, holistic approach, a one-stop shopping for our employees.
That's great. Well, thank you, Stacy. That's fascinating describing. Clearly Boeing is at the cutting edge, so I think we'll have some questions about that, I think. So thank you to the panel for the wonderful presentations. Let me start, and I'll go to the audience in a second. I think we have a little bit of time still. Let me start with a general policy question, since we are across the street from the White House and down the street from Pennsylvania Avenue. Just a general policy question for the panel. All of you have given us very unique insights as to what the industry is doing for workers to achieve financial security as our workforce evolves. Can you highlight one or two legal or regulatory roadblocks that you have seen are impediment to these efforts?
Well, certainly, the things that we believe are really important relative to the regulatory changes are a couple things that we have heard about today also. We believe that expanded use of auto enrollment and auto escalation is really, really important. Increased coverage solutions, such as multiple employer plans, will make retirement accessible to many more individuals. And then finally, we strongly believe that expanded use of lifetime income solutions should be on the legislative agenda, anything from safe harbor for annuity selection and so forth. We think those are priorities. There are other things, certainly, that are important, but those would be the ones that I would highlight.
Great. Anyone else?
I would agree with those. In addition to the safe harbor, we believe that lifetime income disclosures for defined contribution plans would provide additional information for participants as they plan their financial security.
Absolutely agree.
Yeah.
I would say we need to relook at, from a policy standpoint, relook at the parameters surrounding investment advice because it does need to change. And we've moved so far beyond 2006, and we need to not only just look at the savings that you have or your pension, but also include HSAs and 529s and other personal accounts in there too, because it's not just what you do and have at work is not a full picture of someone's life.
That's right.
So.
And then tacking on to what Stacy said at the end of her presentation, as it pertains to the student loans topic, if we're thinking about financial wellness more broadly, there currently are no tax incentives in place either for the employer or the employee related to these employer contribution programs. And so it increases the taxable income for the employee, and the employer currently doesn't have any true benefits or incentives to roll out a plan at scale within their companies.
Great, thank you. Let me kick it to the audience, otherwise I'll fill in. But any questions from the audience? Yes, Rick, there's a...
Hi, Rick Jones from Ann Hewitt. Got a question for Asha on the student loan repayment. So as I've been part of some discussions on that, there's been some discussion about if employer money is on the table, maybe setting aside the notion of doing it through a match or a match in a 401k type of thing. But if there's new money on the table, what conversations have you had around equity considerations associated with that? People that have debt versus don't, or does it produce any ethical issues where people are encouraged to incur more debt in hopes that an employer will help them pay it off? So what conversations have you had around that?
Yeah, no, that's a good question. I think that, in speaking to our HR team in their own considerations when rolling out the benefit within Fidelity, equity was a major consideration, quite obviously. I think that the way that we thought about it was that there are several benefits that we offer as an employer. We're very generous as an employer, and not all of those benefits are really drawn down on equally across all people. So in other words, if you're a single person, if you're not married, the way that you take use of health insurance is not necessarily equal to somebody who's married and has several children. The other thing is, and so as a result, I think just thinking about more holistically our entire employee population, the broader bucket of benefits that we offer, and saying this is something that's important, this is something that we want to offer despite the fact that it may not directly impact every single individual. I think the other thing to note is that on the day that we rolled out this benefit, we also rolled out two others. The other very notable one was extending paid parental leave. And so I think it was part of a broader scheme of Fidelity increasing overall benefits and a wellness package to all of our employees. It just so happens that this is the one that got a ton of media attention and a lot of eyeballs from a lot of other employers out there. And so, I think that it sort of speaks of the times.
If I can add to that, actually, at Prudential, we have piloted and now we are rolling out a student loan management solution in partnership with a company called Student Loan Genius, which provides a very objective platform for individuals to assess their state of student loan debt, help them understand whether they should consolidate, whether they are actually eligible for forgiveness programs, whether they should refinance or simply pay more. It is a B2B solution, therefore enables employee basically payroll deduction, automatic payroll deduction, and then employer match. Our solution also has a match through a non-elective contribution, basically profit sharing contribution, because there is no other vehicle currently available. You are right on the mark relative to the concerns that we have heard from employees and the employers and the conversations that we have had, even with those who have adopted. But I think I would say we start each of those conversations by doing assessment and survey of the workforce for the employer to understand where are the employees with the most student loan debt. The other thing that we help them do is think about their benefit strategy and think about other specific segments of the workforce and population that are specifically, for example, in high demand, and they would like to attract or retain. And a lot of employers are tailoring their programs that way. And when it comes to equity or element of that, I would actually concur with what Asha said here. There are other elements, right? So the fact that you have a daycare program. Not everybody's using the daycare program. And there are other benefits that employers are providing. So it's more about understanding the overall benefit strategy, the pie, understanding what holistically within your employee segments and what the needs are and where, as employers, overall business strategy is leading them to tailor the future solutions. So actually, we have been successful in overcoming that, and we are seeing now adoption of this solution across our client base.
Thank you. Yep, we have a question here.
You mentioned about the need to help people save for retirement because if they delay their retirement, it costs more in employer benefits, and certainly that's the first, that's the first step. But have you, or any of you, especially Stacey, since your employee population is aging, looked at also if people get to that age that either they don't then have enough money or they want to stay engaged in the workforce and the benefits of having them stay engaged and looking at how that translates into like phased retirement programs or working, covering part-time workers, et cetera?
Sure. Well, Ellie is very familiar with this too because we talk a lot about phased retirement. We don't have a part-time workforce, so that's not an issue for us. But phased retirement certainly is. If you have half your population that can retire, you don't want that knowledge base walking out the door. But the way the current system is now, it's very rigid in terms of there's a certain percentage of reduced hours versus a certain percentage of so the laws and regulations have to catch up with that. Now, there's a phased retirement program in the federal government system, but it really hasn't been fleshed out enough on the private side. And we'd like to see that because, look, for one of our engineers, and yes, we have rocket scientists. They don't want to go from 100 miles an hour to 0, and we don't want them to go to one of our competitors at the same time. So how do you create a program that it allows them to reduce a certain amount of hours or refocus that on mentoring, and then at the same time phase out of into retirement. So it's a win-win on both sides. But look, there are some barriers to that. I think it's in our the agenda as well as to what lawmakers can do to address that.
Well, thank you. I think we're just about out of time, so please join me in giving me a round of applause. Thanks, Stacey. Yeah, great. Yeah.
See you.
Good to see you.
Please welcome to the stage Jen Brown from the American University Kogod School of Business.
Thank you. Good morning, everyone. I wanted to say thank you so much to Aaliyah and Jorge for inviting me to speak today. And I appreciate the opportunity to speak with all of you about this very hot topic, the new economy. Before I begin, I want to say a special thanks to Etsy for helping support the Kogod Tax Center in its retirement initiatives and its focus on small businesses. So, what is this new economy? It really is the rise of the on-demand economy. And the on-demand economy, which is also called the gig sharing 1099 platform or Uber economy, began after eBay paved the way for e-commerce and hit its stride during the Great Recession. But not every smartphone app is part of this economy. Buying a dress from Nordstrom online or from its app is not the same as buying a dress from Etsy. In order to better define this economy, the J.P. Morgan Chase Institute in 2016 helped to narrow down the 3.97 million apps available to identify those that constitute the on-demand platforms by developing 4 criteria. These platforms directly connect service providers and sellers with consumers. These platforms process payment electronically using credit cards, debit cards, or other mobile forms of payment. These platforms allow service providers to provide services or goods at providers' discretion, and customers pay for a singular task or good using the platform. Outside of cities such as San Francisco, New York, and even here in DC, these on-demand platforms are viewed as pretty small. But again, the J.P. Morgan Chase Institute found that more than 2.5 million American adults participated in this economy each month, which is approximately 1% of the American population. They also found that 4.2% of all American adults have ever participated in this economy since 2012. And this population continues to grow. In fact, Intuit, the tax preparation and accounting software giant, found that there was more than 3.2 million Americans who worked in the on-demand economy in 2015. And they, Intuit, expect this number to more than double by 2020. According to prominent economists Larry Katz and Alan Krueger, this is the fastest growing sector of the labor economy. And the growth in this on-demand economy represents a much larger trend, the growth of small businesses overall. MBO Partners, who's a back office accounting service provider for small business owners, in their 2015 report found that small business owners, which they term the independent workforce, has expanded faster than general US employment at a rate of 12% per year. They additionally found that the number of full and part-time small business owners in 2015 was 30.2 million. And they forecast that the number of small business owners would number 38 million in 2020. So, what are the retirement savings options for these small business owners? Well, let's first quickly cover the retirement savings options for most employees. Traditional employees, those in standard employer-employee relationships, can be offered a 401k plan by their employer. These 401k plans allow for employees to contribute up to $18,000 in pre-tax dollars to a tax-advantaged savings plan. On the other hand, everyone, including you and I, can contribute up to $5,500 through Myra. Thank you, Mark. And through IRAs such as traditional and Roth IRAs, depending on their incomes. But small business owners, especially those with just one employee, have 2 additional retirement savings options. First, a simple IRA, which stands for a Savings Incentive Match Plan for employees. It's just another flavor of an IRA, which allows for a higher retirement contribution than a traditional or Roth IRA. In fact, small business owners who use these type of retirement plans can contribute up to $12,500 plus an additional 3% of their Schedule C earnings each year. Second, a SEP IRA, which stands for a Simplified Employee Pension, is also another flavor of IRA, which allows for a much higher retirement contribution than a traditional or a Roth IRA. Specifically, small business owners who use these plans can contribute 25% of their Schedule C self-employed earnings to retirement, up to $54,000 a year. So, besides saving for retirement, why would these small businesses want to use a simple or a SEP? Basically, tax deductions. These are items that appear on lines 23 through 37 of an IRS 1040, and these items help reduce these individuals' taxable income. Because contributions to these plans appear on line 28, as you can see by the arrow of an IRS Form 1040, they are considered a tax deduction and help to reduce the amount of income on which these business owners have to pay tax. because the larger the retirement contribution, the larger the deduction for these small business owners. So instead of deducting only $5,500 a year, a small business owner who uses a SEP or a Simple can deduct a much, much larger amount. But even with these incentives out there, small business owners have not utilized these retirement plans. In fact, using IRS statistics of income data, I calculated that only 4.02% of Schedule C filers in 2014, the most recent data available, took a deduction for a contribution to a SEP or a Simple plan. And as you can tell from the chart behind me, this number has stayed relatively low since 2009. Well, why is this a problem? Well, small business owners really aren't saving enough or at all for retirement. In 2010, thanks to EBRI, we know that 45.6% of all workers had no retirement plan. But this number increases for small business owners, who 55% of them in 2010 had no retirement plan, according to the Small Business Administration. So, how can we improve the retirement savings rates of this population? We can make this easier, especially to use SEPs and Simples. And no offense, Mark, if you were to go to the IRS's website and look over the information provided on these plans, your eyes would just glaze over in a matter of moments. The requirements for these plans are very, very complicated. Determining how much a small business owner can contribute to a plan is extremely difficult. There has to be a way to make this easier, especially for do-it-yourself small business owners so that they can save for retirement. Second, we can encourage the use of these retirement plans through tax prep software and financial service providers. More publicity for these plans may equal more participation. Third, financial service providers, especially those who market their retirement plans to small business owners, should really consider offering SEPs and Simples in addition to their traditional IRA offerings. And last, we currently have 4 different types of IRA offerings in this country, 3 with different yearly contribution limits and a myriad of different requirements for contributions and filings and number of employees. Why not just make this a little simpler? Why can't we consolidate all these plans? Why can't we raise the contribution limits and just have one plan? Saving for retirement should be accessible to every single American, especially those who have to do it alone. Uber drivers, Etsy makers, TaskRabbiters, Airbnb hosts, small businesses alike. Thank you so much for listening today. And I'm finished if anyone has any questions. Thank you.
Just one comment. Appreciate your presentation. First of all, a single person 401k is another option there. If they obviously, want to increase their deferrals from the 12.5 in a Simple to, to the 18,000 or 24,000 with a catch-up. I see Mark's in the room. About a year and a half ago, we talked about possibly coming up with some regulations where a Simple could be terminated during a year. I think that's still an important thing. My firm works with a lot of small businesses, and a Simple is a great starting point, but it becomes a hurdle when we can't terminate it during the year and we got to wait another year, or if the client got their notice out by November 1st and they got to wait another year on that. A lot of them, when they're growing quickly, want to make that transfer over to a 401k plan earlier, so some encouragement around that. And I agree with you, if we could get kind of one common plan, it probably would make life a lot easier for a lot of folks.
And I didn't talk about solo 401k plans because of the annual filing requirements and some of the difficulties in actually setting up the plan, especially for the on-demand population. But I do know that they exist. Well, and they are good for certain people.
Yeah, some financial firms do have a very simplified adoption agreement and no annual filing requirement unless it's over $250,000 in assets if they're covering just themselves. So the filing requirement doesn't happen for a while.
Right. And I should also say that these types of plans, whichever type of plan a small business would like to select, really depends on the income levels of the person or the small business and how much they want to contribute to retirement. This is not a one-size-fits-all solution. There are so many different kinds of people participating in this economy, and with different goals in their lives. And we shouldn't think about this as a one-size-fits-all problem, but it needs to be better than the 4 options that we currently have that most people select.
Hi. Question. So Jeremy Smith from the Aspen Institute. The data on how the 4% of the population that's of small businesses that are using these is pretty stark. So talk a little bit, if you will, about what this means for state approaches that include pretty strong incentives, requirements for firms to participate, and what that might mean for small businesses and the self-employed.
So currently I believe it's 20, Angela Antonelli or Jeremy or other people in this room could correct me, it's 27 or 31 states that have actually looked at state retirement savings programs. Only 2 of those states have contemplated self-employment or extremely small businesses being able to participate in these plans. Those are Oregon, and Maryland is thinking about it right now. Because neither of those plans, I mean, Maryland hasn't been set yet, but Oregon is only going to issue or offer a Roth IRA or a traditional IRA. They're not going to consider a SEP or a simple. So the state retirement savings plans really don't cover the on-demand population or the self-employed population. So they actually aren't really an option for a large growing part of the population.
Comments. Couple of questions or comments and a question. I think what you're talking about is the ultra micro small business. And as you know, small business, it's hard to figure out what a small business is, but we know it goes anywhere from at least 1 to 500 employees, and some people say up to 2,000 employees, and there's all sorts of dollar limits involved. We do know, we do have data. It was done by IAMS, Ducey, and Lichtenstein, and it was done under, I believe, Social Security and the Office of Advocacy at the SBA. And they used actual data rather than relying on asking people, are you covered by a plan? They went to the W-2s and got the data. And they broke it down by size of company. And it's rather dramatic because if a company has 10 or fewer employees, I believe the amount of coverage is less than 55%. And some of that is that in the first 4 years of a startup, at least 40% of them don't make it. So you can imagine a startup company is not particularly thinking about retirement benefits. They're just trying to survive and trying not to keep their house to be too mortgaged to get the business going. And then once you go over to like a 25 employees, it dramatically increases. By the time you're at 100, it's virtually the same as almost a much, much larger business. So it's very hard to just say all small business is in this area. I would suggest that having 4 retirement plan options is not too much, and I have yet to find someone confused by IRAs. In fact, many of us in the small business sector do not think that the SEP and Simple are really good plans. We think they're just starter plans. And the reason why, excuse me, is because it's so easy to take money out of an IRA. Whereas if you have a 401k plan, it's much more difficult. And so the balances grow much better because they're not being touched the way they are in an IRA. And I agree with the comment made before that I think in the small business sector you'll find far more 401ks than you would find simples and SEPs, which isn't to say that people shouldn't try to get to that market, particularly the 10 and under employee market. But I think that the data is really skewed and that the small business sector is providing far better coverage than people recognize. And there's a second little part to this which is kind of unusual, which is because the owner has to use the retirement plan for his or her or their own benefit, for their own retirement security, the investments are usually it's usually very well invested, very prudently invested, and the contributions, strictly as a function of the tax code, have to be significant for the staff members who are not owners. And it's not at all unusual for a small business plan to at least have a 3% either profit sharing contribution or match, and it's very often, it's in the 5 to 6, 7% levels. So there's a lot more behind the numbers, and if you're only
Let
finding...
me interrupt you for
Sure.
a second, because I will tell you that Charles Schwab would actually disagree with you. Excuse me. Excuse me. There's actually income limits that they have found where a simple 401k or a solo 401k plan would apply, and where a SEP and a simple would be best for a small business or a small business owner, especially a super small business owner. It hovers around $76,000 is where the dividing line between a simple and a SEP is. So you'd think of anyone below $76,000, they should be considering a traditional IRA or a Roth IRA or a simple plan. And then above $76,000 of net income each year, you should consider a SEP. Beyond $100,000 is when you start getting into the solo 401k range.
Yeah, I don't agree with that at all, particularly if you've got employees, because with employees with a SEP or simple, the money's put into their own IRAs, so they can access it right away, and I think you'll find there's a lot of money that goes out of those. But they're all good vehicles, and I think those of us who work really hard to promote small business plan formation are happy to have companies adopt any of these, but as soon as they can move out of the SEP and simple and into the 401k world, that's the much better world for them to be in.
And I am not disagreeing with you about small businesses that have employees. People that are like sole proprietors, self-employed individuals, that's what I was mostly speaking about. And so I want to say and reiterate, that is the largest growing part of this population. And we have to pay attention to that because it is hugely increasing. I think that I'm finished now. Thank you.
Please welcome to the stage Ted Goldman from the American Academy of Actuaries.
Thank you. Glad to be here. Thanks to the U.S. Chamber of Commerce for including me on the schedule. I'm the last speaker, so please hold on for another 10 minutes, and because we have a very important topic of longevity. I guess I want to start out with a question. How many people could write down on a piece of paper right now exactly how long you will live? Not how long you expect to live, but how long you will live to the day. Hopefully nobody raises their hand. Let me ask a second question. How many people want to know the answer to that question? And I would argue a lot of people probably don't. So where I'm going with this, I think longevity is a really important issue, an important component of retirement security. It's one of those questions we probably don't want to know the answer to, so let's embrace it. Let's not look at it as a bad thing or as a negative thing. Let's look at it as a good problem to have, all right? Let me see if I figure out how to use this. Where's the clicker? Is this it? Oh, the green, okay. So representing the American Academy of Actuaries, so represent about 19,000 actuaries. Imagine the fun of that. And I am an actuary, so I can say that. First, I want to start out longevity, I think, is a word that I don't know how far back I have to go before I hadn't heard that term very often as an actuary even. I don't know if Rick, you would agree with that, but it seems to be commonplace and a common word in our vernacular when we talk about retirement now. And it's one of those words, too, that when you say it a little bit like financial wellness, everybody has their own vision in their head of what that means. So here's 4 definitions of longevity risk for you to think about. The first one is individuals outliving their financial resources. So that's kind of the easy one. All right, am I going to have enough money to make it through here? The second is the uncertainty about mortality improvements. And this has become a really interesting debate within the actuarial community, both in terms of how long we expect the lifespan to last. Are people going to someday be living to 140, 150 years old? But also, how fast are we going to get there? So you can imagine the good conversations there. The third one is additional cost to the system or society at large, and I think that's a lot of the people in the room are dealing with that today. And the last one is the adverse consequences of living a long lifetime, which really start to think, okay, if we do have more and more people living longer, there are some really important implications beside that individual deciding how to save for retirement. Wanted to look at here is some fun facts that no one tell. And in your pamphlets, in fact, is a little card talking about the actuary's longevity illustrator. And this is an outcome of that. And I guess, first of all, the information in the middle, the number of Americans ages 65 and over is projected to rise from 15% to 24% by 2060. Some pretty important implications of that when that happens, of the society and workforce and so forth. But let's drill down on some individuals. The chart on the left is the probability of taking a couple age 65 today in 2017, just turned 65, they're going to retire, and what's the probability that they're going to live at certain ages? People often think about life expectancy, but if you think about planning for retirement using life expectancy, basically planning on a 50-50 coin toss whether you're going to be sufficient or not. So this concept of longevity and probability of living to different ages, I think adds tremendous values to people planning for retirement. And so the couple on the left are 65 years old today, and I just circled two of the ages. So this assumes what's the probability to live 5, 10, 15, 20, 25 more years into the future. And it shows the probability of the retiree spouse, and whether both of them or either of them are going to still be alive. And if I just focus on 20 years out, so this is the probability that at least one of them makes it to age 85 is 84%. So 84% chance that at least one of the two will be alive at age 85. I think when people see that, it really hits home and allows them to think about this in a different way. If we projected this all the way out to age 100, so the 35 years later, the same couple has a 14% chance that at least one of them will be alive by age 100. Okay, these are people 65 today. So it's a long time to plan for retirement and make sure you have appropriate resources. Now let's fast forward to the chart on the right. This one is a couple, both same age, however, they're both 25 years old today. And now let's project them 40 years in the future, and they're ready to retire. Okay, so the chart on the right starts they're at 65, so what's the probability they live to 70, 75, 80, and so forth. Now look at the probabilities of living to age 85, that at least one of them is alive is 92%, so up from the 84%, and the probability that at least one of them makes it to age 100 is 30%. So more than double what the probability is today. So this really emphasizes that we are seeing mortality improvements, we are living longer, we are aging as a society, two really important points to keep in mind. The Longevity Illustrator, I think, is really a pretty neat tool. It's very simple to use, and it shows displays on various approaches. Your homework assignment is to go home, or as soon as you get over lunch, go to www.longevityillustrator.org and play with it. You just answer a few questions. You put in your date of birth, your general health, whether you smoke or not, and you're good to go. So I encourage you, those that share it with your family and friends, those that are employers, send this out to your employees. Those who are providers, put this on your platforms. We've gotten some great press around this and some great feedback. So longevity is a good news, bad news thing. Yes, we're living longer. Your knee-jerk reaction, at least my knee-jerk reaction, is that's great. I'm glad I'm gonna live a longer life and see my kids, and if they have grandkids, and enjoy all that. There's another new word I want to introduce today that's called senescence. Senescence is the process of aging. And the longevity piece, I'd argue, isn't a lot of good if you're not going to have a healthy, longer life. So senescence is the idea of maintaining a healthy life into longer years. I was just at a Living to 100 symposium. There was some research that was being presented on successful drugs they found on mice to help them not live longer lives, but live much more healthy lives up to the very end. So I think that's an important part of this too as we go forward. The bad news is it costs more, right? If I'm going to live longer, I need the money to make sure I can make it that far. And another study that we found, expenses could be 20 to 35% higher for the people who are living longer than the people who live the average lifetime. So this is a real dollars and cents type of issue as well. I want to talk a little bit about longevity from the worker and retiree perspective, and then a little bit from the employer perspective, and then wrap up. From the worker and retiree perspective, we're now clearly in a defined contribution world. And I don't mean that in the sense that everybody has a defined contribution retirement plan. I mean that in the sense that virtually everything we do, the individual at the end of the day is responsible for their own lives and need to make a lot of important and complex decisions to get there. So that is a mindset that I don't know that everybody is ready for, and many people don't have the knowledge and skills to make a lot of those decisions. When it comes to retirement, I even put a third category of people who have the knowledge and skills, but they're so focused on other aspects of their lives and so busy that they don't take the time out to sit down and go through the planning, or if they do, they did it on one weekend and they put it in their shoebox, and that's the end of it. And then coupled with that is a low understanding of longevity risk. There was another study that showed, I think, 38% of pre-retirees and 40% of retirees were guessed wrong about their life expectancy by more than 5 years. So people, really that first chart I show, I did it for a reason to drive that home for people. Some other factors, there's a reluctance on people's part to hire professional help. I think everybody would argue professional help is good, tends to migrate to the high end of the income scale, which is not a surprise. So there's a lot of workers out there that think they can't afford it or don't want to get that help. A reluctance to purchase life annuities. You have that lump sum, that shiny ball of lump sum money versus converting that into lifetime income, which we all know is good for people, but there's a real hesitancy to get that. We've introduced things like QLACs, the qualified longevity annuities, to try to say, let's just protect yourself against the tail end, but a challenge to get people to embrace that, we're seeing. Rules of thumb are out there. You take 4% of your money down, things like that. Those are great. For some people, they don't always work, though, and it's just a little risky to say I'm going to live my life by rules of thumb. And then the longer we're going to live, the more potential for some of the retirement shocks you might see in terms of poor health, in terms of inflation, importance of inflation over that longer retirement period, if that's what's happening. And then there's a new one I added on. I personally have a couple of really nice defined benefit plans, and as an actuary, I'm thrilled with that. But even as taking off my actuarial hat, I'm still thrilled with that. It gives me a level of security that I really can't describe. But we're seeing some risk of DB promises, too, in the multi-employer space. We just had the first MEPRA approval, and the plan voted, so you're going to see retirees cutting their benefits starting tomorrow type of thing. A really scary concept. Same in the public sector. So what you thought was secure in there may not be there. So another kind of risk that we need to think about. So at the end of the day, both sides of this coin are a little bit dangerous. You have the overestimating your life expectancy or underestimating. Underestimating, you could have maybe spent more money and lived a more happy retiree. I hear from a lot of people, their parents, they're very cautious about what they spend. They have money, but they don't want to spend it. There's this fear of running out of money. So if you can secure that, the better. From an employer standpoint, those employers that do still sponsor defined benefit plans, it's an increase in your cost as people live longer. You did nothing to change your plan design. You did nothing to change your assumptions. People are living longer. There's more money coming out of the employer's pocket to fund those defined benefit guaranteed obligations. Increases in workforce challenges, too, is a huge issue. With defined contribution plans, when you think about it, there's less control from the employer side. There's no normal retirement age anymore. There's no ability to have early retirement subsidies to suggest people can go out early. There's little ability to do open early windows. So we've taken away some tools from employers to manage that workforce. And then we heard some of the comments today from Boeing and so forth. Do you want people to stay on longer? Some employers will. If people stay on longer, are they blocking careers of younger people? So a lot of important issues there. And then we talked a little bit today, too, about the automatic features of DC plans have been very effective, but they can create a false sense of security. Oh, I'm in a 3% default. That must be my right answer. And then finally, addressing longevity. And I guess one of the things, too, I forgot to say was people are delaying retirement. We're seeing study after study where the new retirement is, I'm not going to retire. I'm going to work as long as I can, which is good for some people, but we also see statistics that you may not have that choice, either losing your job or your health or caring for somebody that you need to do. So what can we do to address longevity? I think employers are still perceived as a trusted source of information, and that's why I'm a big fan of the financial wellness and total well-being approach. And I think the employer has, to the extent employers can provide tools and resources and education, that's a really great source of information to help people with these challenges. Public policy is another area we've talked a little bit about today where there's opportunity to provide more safe harbors, to make it easier for people to buy annuities, to get the longevity pieces, to build that into their solutions. And then I'm very optimistic that we will see, we had a session earlier on innovations, that we will see innovations on DB. There's an emerging DB risk-sharing approach that's come up into the multi-employer space, but I think it may have applicability more broadly, where it takes a DB approach, focuses on lifetime income, focuses on professionally managed assets, but allows the employer to not have that liability on their balance sheet and take the risk. Behavioral, what I call behavioral DC plans. I think we're seeing DC plans evolve. Automatic features are a good thing, but they fall short. Not everybody wears the same size shoe. So I think we're going to see DC plans catered more specifically to individuals and have really smart defaults instead of generic defaults. And finally, I think we'll see, as demand rises, and we'll see more solutions in the lifetime income solutions and longevity space. So those are the things that I think we're going to see on longevity. Appreciate you staying with me, and I think I'm the last thing keeping you from lunch. Thank you.
Thank you very much, and thanks to all our speakers today. I will have very abbreviated closing remarks, really with two purposes. One is to summarize kind of the Chamber's wish list for 2017 in this space. First and foremost, obviously, today's announcement that there will be a delay in the fiduciary rule and an opportunity to really fix a rule that was broken from the get-go is good news. We've encouraged Congress to also look at the state-based plans and kind of use CRA to rescind the steps that DOL took last year. As the paper in front of you outlines, that's not a good choice for employees or employers. It's the wrong choice. But most importantly, and I think the foundational element of this is that what we hope will happen in 2017 is a real conversation around how do you improve on what's working, how do you expand it, and I think the ideas that that Randy and Aaliyah put on the table today, the study, the discussion this morning, the contributions of each of the panelists will hopefully get us kick-started into a conversation with Congress on a bipartisan basis on how do we really expand access, how do we make it easier for Americans to invest and save and give them the choices they need. That's the one regret we have from the real debate last year, was all entirely focused on investor protection, which we strongly agree with, but absent from the conversation was doing so in a way that also addressed the importance of expanding access and making it easier for all Americans to save and invest. So I would just like to close by asking Randy and Aaliyah to stand up so we can give them a big hand of applause and thank them for all their work. Aaliyah deserves double thanks, both for all the work she put in and for putting up with Randy. And Randy, thank you for being such a great colleague and partner. And we look forward to rolling up our sleeves. The one thing Tom Donahue does not allow is the issuance of reports that look pretty on a shelf and gather dust. These are actionable ideas, things we can get to work on, and things that we should all work together to educate the Hill on, to educate the administration on, and to help them become effective. Wouldn't it be great to end this year with multi-employer plans expanded with some of the real solutions that are in here available to Americans as they enter 2018? Thank you very much.